Good morning and welcome, everyone. This is an open meeting of the Public Company Accounting Oversight Board on November 21st, 2024. We welcome those of you who have joined us today by webcast or dialing into the teleconference. Before we proceed with the agenda, I will note for the record that all board members are participating in this meeting and we are able to hear one another. The first order of business before the board today is a staff recommendation that the board adopt amendments to its rules and reporting forms to require the reporting of specified firm-level metrics on new Form FM firm metrics and specified engagement level metrics on an amended and renamed Form AP Audit Participants and Metrics. To present the staff's recommendation, I will turn to our Chief Auditor, Barbara Vantage.
Good morning, Chair Williams and board members Ho, Stein, Thompson, and Bodick. The Office of the Chief Auditor is pleased to recommend that the board adopt final rules that require certain registered public accounting firms to publicly report specified firm and engagement level metrics relating to their audits and their audit practices. Calls for firm and engagement metrics, previously referred to as audit quality indicators, have been heard in the earliest of this board's public interactions. For example, in June 2022, a member of the Investor Advisory Group and the Standards and Emerging Issues Advisory Group commented that AQIs should have been on the initial standard setting agenda put forth under this board. In September 2022, several commenters on the board's strategic plan highlighted the importance of audit quality indicators. We had a discussion with the Investor Advisory Group in October of 2022 and the Standards and Emerging Issues Advisory Group in November of 2022. Subsequently, the staff developed a proposal, which the board approved in April 2024. We received the majority of comment letters before the end of June, and we are making a recommendation today that the board adopt metrics in 8 areas for a total of 8 firm level and 6 engagement level metrics. The final rules draw on input from numerous sources, including the recommendations of the U.S. Department of Treasury's Advisory Committee on the Auditing Profession, set forth in their 2008 final report, the board's 2015 concept release, the 2024 proposal and the comments received, input from our advisory groups, initiatives of regulators in other jurisdictions, and relevant academic research. Some firms already publicly disclose certain firm-level metrics through their audit quality or similar documents. However, there are no common definitions or calculations allowing for consistent comparisons. Moreover, most of the disclosures are voluntary, so firms are free to revise or discontinue such reporting at any time. Firms also use engagement level metrics internally and report certain engagement level metrics to the PCAOB as part of our inspection process. This voluntary reporting regime does not provide consistent, comparable information that stakeholders can rely on to inform their decisions over time. And it would appear that firms' attempts at voluntary reporting have not, in fact, satisfactorily addressed investor desire for additional information about audits or auditors. On the contrary, support from investors and investor-related groups for this rulemaking have been consistent throughout its history, even as the practice of firms' voluntary reporting has evolved. Public reporting of standardized firm and engagement level metrics will create a useful data set available to investors and other stakeholders for analysis and comparison. This will advance investor protection and promote the public interest by enabling stakeholders to make better informed decisions and promoting auditor accountability. Additionally, this information could be beneficial to firms in evaluating their audit practice and related system of quality control. The board itself would benefit from having additional data to use in its oversight activities, including in its inspection programs and standard setting initiatives. After considering commenter input, we've made a number of changes from the proposal. As the other staff presenters will further elaborate on, the final rules eliminate several proposed metric areas and add one new metric area. We have also made revisions to simplify and clarify some of the other metrics and exempted firms with a smaller issuer practice from reporting on their industry experience. We believe these changes, along with others, will address commenter concerns about the challenges of data collection, potential sensitivity of data, and potential ambiguity of the metrics, and that the final suite of metrics will provide consistent, comparable information on auditors and audit engagements, giving investors, audit committees, and other stakeholders valuable new context and perspective. Stephanie Hunter will now provide an overview of the final metrics and associated reporting. But before I turn the floor over to Stephanie, I would like to acknowledge the many people within the PCAOB who provided significant contributions to this project. I would like to express my sincere appreciation to Jessica Watts, Karen Wiedemann, Stephanie Hunter, Claire Sever, Akiko Upchurch, and Skylar Sims from the Office of the Chief Auditor, the team that led this project. I would also like to thank Lynette Kleindinst of the Office of the Chief Auditor and others who supported the team leading this project. I would like to thank our colleagues from other divisions for their significant contributions, in particular, Martin Schmalz, Nick Galunik, Eric Durbin, Josh White, and Eric Carlson in the Office of Economic and Risk Analysis, Connor Rasso, Catherine Kelly, Vince Meehan, and Mark Francis in the Office of General Counsel, the Division of Registration and Inspections, the Office of International Affairs, and the Division of Enforcement and Investigations. I would like to thank the board staff for their input and help along the way. And finally, I would like to thank the staff of the Securities and Exchange Commission for their support and timely assistance with the project. And with that, Stephanie, I'll turn it over to you.
Thanks, Barb. Good morning, Chair Williams and board members. As Barb has said, the information provided by the metrics will increase the set of information available to investors, audit committees, other stakeholders regarding their auditor's performance. This will improve both investors and audit committees' ability to monitor their auditors. While audit committees may already have some information about their auditor or their audit, they do not receive the information in a standardized form or have information from other firms or similar engagements that enable them to compare their audit and their auditor with others. With access to such information, audit committees will now have tools to use in monitoring their work and selecting auditors. We are recommending the board adopt firm and engagement metrics in 8 areas. Most metrics will be reported at both the firm and engagement level, but for 2 of the metric areas, retention of audit personnel and restatement history, there will be reporting at only the firm level. Now I would like to provide a few highlights within each of the metric areas. Partner and manager involvement. These metrics provide the hours worked by senior professionals relative to more junior staff across the firm's large accelerated and accelerated filer engagements and on the specific engagement. Workload includes average weekly hours worked on a quarterly basis, including time attributable to all engagements, administrative tasks, training, and all other matters. These workload metrics will be provided for senior professionals who incurred hours on large accelerated or accelerated filer engagements. Training hours for audit personnel. This metric area will include average annual training hours for partners, managers, and staff of the firm combined. On to experience of audit personnel. These metrics show average number of years of experience of senior professionals at public accounting firms. Industry experience. These metrics show the average years of experience of senior professionals in relative industries. Retention of audit personnel would capture continuity of or changes in senior professionals through departures, reassignments, and the like across the firm. Allocation of audit hours will show the percentage of hours incurred prior to and following an issuer's year end, both across the firm's large accelerated and accelerated filer engagements and on that specific engagement. And finally, restatement history. This metric will show restatements of financial statements and management reports on ICFR that were audited by the firm over the past 3 years. This new information provided by the metrics will allow users to draw inferences about audits and audit firms that are not possible today. Some may relate to specific metrics. For example, a heavy workload for a particular engagement team relative to the firm average may raise questions about the quality of the work performed. Conversely, a relatively high level of industry-specific experience, particularly for an engagement in an industry requiring specific accounting and auditing expertise, would be a positive signal. Others may relate to combinations of metrics. For example, the personnel-related metrics taken together give an overall sense of how an engagement is staffed that can be compared to firm averages and to similar issuers. In general, we believe the metrics will be useful in conveying a sense of whether a particular engagement or firm appears fairly typical or is an outlier in one or more respects. This should provide a richer context for understanding the work of the auditor than the current environment of almost no publicly available information. We believe that gathering data and calculating the final metrics, given the subjects they address, will not be overly costly, time-consuming, or burdensome to firms. Many of the metrics are based on data that firms already track or will be required to track for purposes of other PCAOB requirements. For example, partner and manager involvement and allocation of audit hours are based on the same time reporting required for Form AP purposes. Training hours will reflect the same information that firms track to ensure proper licensing of their personnel. Firms should be able to generate other data required by the final metrics, such as workload, from their existing timekeeping systems with minimal additional effort. The adopting release includes a set of terms and concepts. Where practical, the key terms align with existing definitions and PCAOB standards and rules. In other cases, for example, to help with the consistency of calculating metrics among firms and engagements, we have established certain terms regarding people who participate in audits, including the terms for partners, managers, and staff. Firm-level reporting will be required for firms that audit at least one accelerated filer or large accelerated filer, as those terms are defined in SEC rules. The determination of whether a firm is required to provide firm-level reporting will be made every 12 months, as of September 30. Engagement-level reporting will be required for every audit of an accelerated or large accelerated filer. The firm-level reporting requirements will apply to approximately 210 firms, including 22 of the top 25 U.S. firms by total firm revenue. It is estimated that the engagement level reporting requirements will apply to approximately 3,400 issuer audits, representing 99% of the total market capitalization of issuers reporting on Form 10-K and Form 20-F. Firm-level metrics will be filed with the PCAOB on a new Form FM firm metrics, covering the 12 months ended September 30 in each year, and required to be filed with the PCAOB by November 30th. Engagement level metrics will be filed with the PCAOB on a revised and renamed Form AP, Audit Participants and Metrics. As a reminder, for most audits, Form AP is due within 35 days after an audit report is first included in an issuer's SEC filing. Data on Form AP will continue to be downloadable and machine readable. Finally, firms are permitted, but not required, to provide a brief narrative disclosure together with any or all of the firm level and engagement level metrics they report. This will give firms the ability to provide any context they thought necessary for an appropriate understanding of the reported metrics. We have updated the effective date from the proposal. If approved by the SEC, the effective date of the firm level metrics will be October 1st, 2027, with the first reporting as of September 30, 2028, and engagement level metrics for the audits of companies with fiscal years beginning on or after October 1st, 2027. There will be a phased implementation period for smaller firms. The requirements will take effect in the first year for firms that audit more than 100 issuers, and for other firms, the requirements will take effect the following year. I will now turn the floor over to Martin Schmalz in our Office of Economic and Risk Analysis.
Good morning, Chair Williams and board members. The Office of Economic and Risk Analysis has performed an economic analysis of the final rules. The economic analysis includes establishing a baseline under today's rules, identifying a need for rulemaking, evaluating the economic impacts of the final rules, and assessing reasonable alternatives. We appreciate the input of commenters on the proposal and have carefully considered the information provided to us through the notice and comment process in developing the economic analysis for this adopting release. We believe the economic analysis contained in this release even-handedly sets out the likely economic effects of the final rules. I'll now turn it over to Nick Galunik, Assistant Director, Economic Analysis, to present the details of our analysis.
Thank you, Martin. Good morning, Chair Williams and board members. Investors and audit committees cannot easily observe the services performed by auditors. This limits their ability to assess the quality of service they are currently receiving from their auditor, as well as the quality of service they could potentially receive from an alternative auditor. As a result, their decision-making is less efficient and effective than it otherwise could be. The final rules will help address this problem by mandating public disclosure of a variety of firm and engagement level metrics. Final metrics relate to various aspects of audit processes and outcomes. By specifying how they should be calculated, the final rules will help ensure that the final metrics will be comparable across firms, engagements, and time. Firms could also voluntarily provide a brief narrative disclosure to help investors and audit committees accurately interpret the additional reporting. Though the final metrics could not be used to determine per se the quality of an individual auditor or an individual audit engagement, they would nevertheless inform investors and audit committees' decision-making. Audit committees are currently able to request and receive certain information from firms on an ad hoc basis. However, the final metrics will likely be more comparable and accessible than similar information audit committees could otherwise gather independently. We've analyzed the benefits and costs of the final rules. The final rules will likely improve audit committees' ability to monitor and select auditors and investors' ability to make decisions about ratifying the appointment of the auditor, voting for members of the board of directors, including directors who serve on the audit committee, and allocating capital. Auditors could have an incentive to compete on the basis of the final metrics. These effects could improve the quality of audit services and, in turn, the quality of financial reporting. The final rules could also reduce costs incurred by audit committees and investors when gathering information about auditors independently. Finally, the final rules could enhance the effectiveness of PCAOB statutory oversight and scholarly auditing research. Firms could incur costs to build an appropriate reporting infrastructure or update existing infrastructure. They will likely also incur costs to produce the final metrics. For example, firms will need to gather engagement level data, make the required calculations, design and operate appropriate controls, and prepare and submit the relevant filings. Firms may need to train personnel to operate and administer their expanded reporting systems. As my colleagues from the Office of the Chief Auditor highlighted, we made several changes to the proposed rules in response to commenters' views. These changes should make the final rules more cost-effective. I thank our PCAOB colleagues in the Office of the Chief Auditor, the Office of the General Counsel, the Division of Registration and Inspections, and the Division of Enforcement and Investigations, as well as SEC staff for their support in developing the economic analysis. I will now turn the floor back over to Barb Vanich for the staff's recommendation.
Sorry for the delay. I'm having a technical issue. Thank you, Nick. In closing, the staff is recommending that the board adopt final rules, forms, and amendments related to firm and engagement metrics and issue an accompanying adopting release in substantially the form before you. To instruct the staff to submit the final amendments to the SEC on Form 19B4 for the Commission's approval pursuant to Section 107B of the Sarbanes-Oxley Act, and request that the Commission determine under Section 103A3C of the Sarbanes-Oxley Act that the application of the amendments to the audits of emerging growth companies is necessary or appropriate in the public interest after considering the protection of investors and whether the action will promote efficiency, competition, and capital formation. Thank you.
Thank you, Barb, Stephanie, Martin, and Nick. At this time, my fellow board members and I will have an opportunity to make a statement or ask questions to the staff. We will proceed in the order of seniority, and I will begin. Quality audits boost confidence in our capital markets, which is essential for investor protection. The PCAOB plays a critical role in advancing quality audits, but so do auditors, audit committees who select the auditor, and investors who ultimately ratify an issuer's choice of auditors. Since at least 2008, investors have made clear that they do not have access to transparent, reliable, and comparable information relating to the audit. Those views helped shape the recommendations of the U.S. Department of Treasury's Advisory Committee on the Auditing Profession in 2008. The ACAP recommendations, along with over a decade of PCAOB staff's regulatory experience, eventually led to a concept release approved by the board in 2015. The purpose of that release was to garner feedback from investors, audit committees, and other stakeholders on the disclosure of a proposed set of metrics related to an issuer's engagement team and the engagement team's respective audit firm. Today's release has also been informed by international regulatory requirements or disclosure requirements of the same or similar metrics in other jurisdictions. When the board approved our 2022 through 2026 strategic plan, which guides the work we do to achieve our investor protection mission, we acknowledge the importance of transparency through objectives focused on the PCAOB providing more information to the public related to our inspection and enforcement activities. To advance those objectives, we proposed firm and engagement level metrics in April of 2024. The goal of this project before us today is to provide additional information about audit firms and their audits in both a consistent and comparable manner to bolster confidence, strengthen oversight, and empower investors and audit committees to make better informed decisions and help drive audit quality forward. Today, investors and other stakeholders lack information about audit firms' practices and their engagements, some of which may be shared with company management or their audit committees. Through this project, investors, audit committees, and other stakeholders will have access to the same valuable information on firms and their engagements to help them make knowledgeable decisions regarding audit firms and investment-related choices. For example, collectively, the information disclosed will provide a basis for audit committees to make more informed decisions in maintaining and monitoring auditors, and it will provide a basis for investors to make more informed decisions when ratifying auditor appointments, electing board members, and allocating capital. This project also could benefit firms if they choose to use the metrics in monitoring and remediation process as part of their quality control system. And finally, the PCAOB will also benefit from having additional tools to use in its oversight activities, including its inspections program. Over time, the benefits stakeholders will receive from these metrics will increase as trends become more apparent, enabling the benchmarking of information across engagement teams and firms. Ultimately, the disclosure of this information will allow consumers of audits to make more informed decisions as they fulfill their role in driving audit quality. Before I speak about the adopting release, I want to acknowledge the tireless work of so many people over the last 16 years, starting with the ACAP recommendations and members of the PCAOB staff who have been working on this project since at least the 2015 concept release. I also want to thank all of you who commented on our proposal. Building on countless hours of research and outreach by our professional staff leading up to the proposal, your input was extremely helpful in leading us to arrive at the set of metrics addressing the 8 topical areas just presented to us by the Office of the Chief Auditor. And as you just heard, if approved by the SEC, based on the feedback received, the requirements will have a phased implementation period with an effective date for annually inspected firms following 2 years after such approval, providing firms sufficient time to update their systems and take other measures to prepare for the reporting requirements. All other firms that meet the reporting criteria will have 3 years to prepare for the disclosure requirements. As our professional staff noted in their recommendation, earlier this year, this board approved a proposal for public comment that set out a standardized set of 11 metric areas for every firm that audits at least one public company classified as either an accelerated filer or a large accelerated filer to disclose each year. As we noted in the proposal, since the concept release in 2015, many annually inspected firms have been disclosing information about their audit practices through their audit quality reports, transparency reports, or other published documents. However, most of the metrics disclosed are not necessarily consistently disclosed or calculated, are not necessarily consistent between firms. And in the rare cases that the same metric is disclosed, there is no guarantee that the calculation is consistent between firms. And to find such information, one must search through a firm's various publications. Critically, as members of the auditing profession recognize, reliability and comparability of information is critical in deriving confidence in the market. This project will lead to reliability and comparability of the metrics to be disclosed by requiring the calculations to be consistently applied across firms that meet the disclosure criteria. And the information will be maintained on our website so that it is easily accessible by all stakeholders. Ultimately, as the presentation from the Office of the Chief Auditor noted, we proposed 19 metrics and 11 areas, 10 at the firm level and 9 at the engagement level. The final requirements include 14 metrics in 8 areas, metrics at both the firm and engagement level for 6 areas, and metrics at only the firm level for 2 areas. We eliminated 4 metrics that were proposed in response to comments received and made the disclosures more scalable with lagged implementation to provide additional time for firms to prepare for the disclosures. Almost all of the metrics we are adopting today are disclosed by most all of the top 8 global network firms in some manner. I would like to thank the many staff at the PCAOB for their work on this project. Specifically, I would like to thank in the Office of the Chief Auditor, Barb Vantage, Jessica Watts, Stephanie Hunter, Karen Wiedemann, Claire Severdenden, Skylar Sims, and Akiko Upchurch, and in the Office of Economic Analysis and Office of Economic and Risk Analysis, Martin Schmalz, Eric Durbin, Nick Galunik, and Eric Carlson, and the Office of General Counsel, James Capoli, Connor Rasso, Catherine Kelly, Vince Meehan, and Mark Francis. In addition, I would like to express my gratitude to my fellow board members and their staff for their contributions to this project. Since June of this year, when the board received substantially all of the comments on this project, my fellow board members and their staff have engaged with our Office of Chief Auditor for countless hours. For the last nearly 2 months, they have provided multiple rounds of written comments in addition to meeting with my staff to improve the release before us. I would also like to recognize the support provided by the staff from the Division of Registration and Inspections and the Division of Enforcement and Investigation, the Office of International Affairs, and the Office of Communications and Engagement. And finally, I would like to thank the Securities and Exchange Commission staff, including the staff of the SEC's Office of the Chief Accountant, for their support and assistance. And now I will turn to my fellow board members for any statements they may wish to make or questions they would like to pose to the staff. Board Member Ho, the floor is yours.
Thank you, Chair Williams. Our votes today are unprecedented. Never in the history of the PCAOB has the board rushed to adopt new standards and rules in the middle of a historic transition to new SEC leadership, let alone adopt standards and rules that are not ready. The firm and engagement metrics was proposed on April 9, 2024. And we received 46 comment letters. If adopted today, it will set the record for this board as the fastest adopted standard, which only took 226 days, 7.5 months. The average number of days from proposal to adoption for the 5 standards adopted by this board to date was 448 days, 15 months, with an average of 32 comment letters. Essentially, although the firm and engagement metrics proposal has over 40% more comment letters than the average of 32, it took half as much time as the other standards adopted by this board. Political expediency is not evidence-based policymaking. Haste naturally harms work product quality, which will not escape any keen eyes. In my statement on the firm and engagement metrics proposal, I stated that I am a strong advocate for data transparency and express support for standardized reporting that is accurate, helpful, and a good fit for its proposed use, consistent with the Paperwork Reduction Act principles. To reiterate, the Principal Reduction Act principles are designed to ensure federal agencies, one, do not overwhelm the public with unnecessary or duplicative requests for information, and two, facilitate decision-making based on high-quality data. The PCAOB is not subject to PRA, as it is not a federal agency. However, if we were, I believe our standard setting process here has failed to align with these principles. I applaud the staff for considering some commenter feedback and reducing the proposed 11 metrics to 8, which includes the elimination of proposed metrics where I express concerns, for example, audit resources, use of auditor specialists and shared service centers, and audit hours in risk areas. Effective regulators should listen to key stakeholders to inform rulemaking. However, I am not convinced that PCAOB has taken comments from key stakeholders as seriously as it should, since the majority of the commenters do not support the proposed metrics. In my analysis of the overall sentiment of comment letters, over 70% of commenters expressed concern. For example, many commenters expressed their opposition to the engagement level metrics and related public reporting. Yet, despite this opposition, this adopting release includes 6 engagement level metrics. In my statement on the proposal, I mentioned that I used 3 questions to consider the metrics proposed. These same 3 questions have provided a framework for me to methodically consider this adopting release. First question, will the information we're proposing to collect be accurate? A commenter conducted an audit committee survey that cited 73% of audit committee members surveyed state there are potential challenges and limitations in interpreting proposed metrics, particularly in relation to measuring audit quality. And 82% cite concerns about data specific to their audit being publicly available. Another commenter questioned whether the metrics are unambiguous, whether the metric could be interpreted on its own without additional context, whether disclosure of the metrics would result in a behavioral change to improve audit quality, and whether the metrics would pose an administrative burden. To mitigate misinterpretation and comparability across firms, the adopting release attempted to allow context by including an optional narrative disclosure, while simultaneously handcuffing firms to a limited number of 500 to 1,000 characters. 1,000 characters is about 150 to 200 words. That is the same length as my opening paragraph. With technology like artificial intelligence, why even impose a character limit? ChatGPT 4.0 can handle over 4,000 characters at one time. And Google Gemini 1.5 can handle over 1 million characters. Today's adopting release prescriptively restricts firms' ability to provide adequate context so that the metrics are easily understood and not misinterpreted by the users of this information. Such arbitrary restrictions do not reflect modern technological advancement and undermine the accuracy and quality of the information to be reported and ultimately published. Second question I ask, will the information we are proposing to collect be a good fit for its proposed use? The foundational principle of all PCAOB standards is to protect investors by improving audit quality. A commenter states, it is unclear whether disclosure of firm and engagement metrics will meaningfully increase auditor accountability beyond the existing source of accountability. Therefore, what is the underlying problem that this proposal is trying to solve? As an example, the adopting release includes a metric for the training hours for audit personnel, which begs the question, how will the average annual training hours clearly be indicative of audit quality? Ironically, for this particular metric, the economic analysis admits that overall, the academic literature provides mixed evidence regarding how auditor training relates to audit quality. Yet this metric is retained in the final release. All CPAs have state-required training requirements. For example, the Virginia Board of Accountancy states that active CPAs must complete 120 CPE hours over a rolling 3-year period with a minimum of 20 hours annually. Since training is mandatory across states for licensure purposes, this is redundant information which adds no value in ascertaining audit quality, much less investor protection. Our standards appear to be based on the proposition that more is better in terms of public company audit firm disclosures. Yet the PCAOB does not believe that to be the case when it comes to soliciting public comment on its proposed standards and rules, because it only gives stakeholders a 60-day comment period, which is particularly short given the PCAOB simultaneously proposed standards. Some commenters requested an extension of the comment period deadline, which the PCAOB ignored. Other commenters suggested that the PCAOB pilot test the final rules before adopting them. However, the economic analysis dismisses this alternative on the basis that the pilot would likely be voluntary, potentially with a limited group of participating firms, which may not be representative of all firms, and points to skewed results that would limit applicability. I'm supportive of a pilot study prior to adopting this final standard, particularly with engagement level metrics, to gain more insights on what would or would not be beneficial information to investors. But conducting such a pilot would take time. And while the PCAOB states that it is committed to getting its adopting releases right, actions speak louder than words. And this midnight rulemaking demonstrates the hollowness of the PCAOB's rhetoric. This hollow rhetoric carries over to the economic analysis repudiation of a pilot because of a so-called limited participation problem, especially since there is a simple solution. Specifically, invite a representative sample of firms to participate. Given that commenters were the ones that suggested a pilot, I believe it's safe to assume there would be plenty of firms interested in participating. And how would we know if we do not even try? The results of a pilot study would provide vital insights into developing standards that have actual utility and direct connectivity to audit quality. Instead, the standard adopts burdensome metrics that have an unproven correlation with audit quality. Third question, will the information we're proposing to collect be helpful to the targeted users? PCAOB points to audit committees and investors as the targeted users of these metrics. A commenter's audit committee survey cited that audit committee member survey largely indicated they currently have the information they need today. Specifically, this survey found that 95% of audit committee members surveyed say the information available to them to fulfill the external auditor oversight responsibilities meets most of all their needs. 78% of audit committee members surveyed are concerned that mandated public disclosure of engagement level performance metrics, including issuer name, could lead to unintended consequences and should be voluntary. 80% of audit committee members surveyed rarely or never use PCAOB Form AP or are unfamiliar with it. 78% of audit committee members rarely or never use the PCAOB's register firm website or are unfamiliar with it. In this same comment letter, the commenter pointed to the results of their investor survey, citing that 93% of investors surveyed trust the audit of financial statements, and a little over half trust it completely. And 92% of investors surveyed feel the information available to assess the quality of the audit of a publicly traded company meets all or most of their needs. Yet, our economic analysis points to two observations to address the economic problem that this standard is supposed to solve. Specifically, that investors and audit committees cannot easily observe the services performed by auditors. And furthermore, there are currently insufficient incentives for firms to fully meet the market demand for accurate, standardized, and decision-relevant information. Additionally, a commenter representing audit committees expressed concern that public access to the metrics could increase unnecessary risks, fearing public disclosure could result in litigation and reputational risks. The economic analysis acknowledges that the metrics could encourage some frivolous lawsuits, but states that it will largely contribute positively to audit quality. Even though the economic analysis lacks any supporting evidence or research to back its audit quality conclusion. In addition, the PCAOB dismisses commenter concerns by blatantly ignoring or at best downplaying audit committee and investor commenters, who are among the intended users, of which more than a supermajority have stated that they have all or most of the information they need to assess audit quality. As I have stated previously, continuing to force feed the auditing profession with a voluminous number of standards within the limited funnel of a couple years is going to have catastrophic impacts to audit quality. Capacity is an important factor that the PCAOB has not seriously considered as part of its most ambitious standard setting and now midnight rulemaking agenda in PCAOB history. To put it into perspective, the amount of rainfall from Hurricane Helene in North Carolina alone caused biblical devastation due to the lack of capacity to absorb the deluge in such a short period of time. Are we intentionally creating a deluge to cause biblical devastation to the auditing profession and by extension to investors at large? In terms of capacity, several commenters suggested the consideration of the cumulative effects of this standard, along with other rules and standards. However, our economic analysis rejects conducting an evaluation of the integrated impact, aggregated effects, and cumulative costs versus benefits of all the new standards, despite several commenters suggesting that the PCAOB do so. Specifically, the economic analysis states consistent with long-standing practice and the PCAOB staff guidance on economic analysis, the board's economic analysis for each rulemaking considers the incremental benefit and cost for the specific rule, i.e., the benefits and costs stemming from that rule compared with the baseline. The economic analysis states that there is limited academic evidence about whether the benefits exceed the costs because the necessary data does not exist. In other words, our economic analysis admits that limited evidence was gathered to support the adoption of the standard qualitatively or quantitatively. With respect to costs, the plethora of new standards, specifically the 5 adopted standards, 7 short-term standard setting projects, 7 midterm standard setting projects, 2 research projects, and 3 rulemaking projects, will lead to exorbitant amount of implementation costs. However, our economic analysis does little to effectively quantify the anticipated total cost of this standard, nor the cumulative impacts of all the newly adopted standards. Shockingly, the adopting release states, we also believe that gathering data and calculating the final metrics, given the subjects they address, will not be overly costly, time-consuming, or burdensome. However, the economic analysis in relation to direct and indirect costs associated with the final rules states that most of the costs are intractable to quantify and admits that it is difficult to estimate the potential costs that audit firms will incur to produce the final metrics, owing in part to the variability in firms' current systems. However, the economic analysis attempts to extrapolate impacts from prior PCAOB disclosure rules, specifically the critical audit matters standard, and concludes that the population of firms expected to be impacted by the final requirements implies a total cost of approximately $67 million. Note that this estimate does not include system implementation costs, nor recurring system maintenance costs. For system implementation costs, the economic analysis references the implementation of enterprise resource planning systems and indicates that the cost could be up to $512 million if firms were implemented from the ground up. The CAM standard has very different reporting requirements than this standard, and it did not require a collection and validation of large amount of data from numerous systems. As such, I agree with the economic analysis that the cost to implement the firm and engagement metrics standard could be much higher. Now, I do not expect penny perfection, but I do believe we should provide a better assessment of the economic impact of these reporting requirements along the lines of whether this rule is likely to result in an annual effect on the economy of 100 million or more, which I have derived in part from the Congressional Review Act's definition of major rule. It is clear to me that our rush standard setting agenda will increase audit fees exponentially, reduce capital formation, drive out audit competition, and intensify the talent shortage within this profession. So I ask again, are we really protecting investors? Another commenter believes that only a small percentage of investors will benefit from this proposal, and also acknowledge the indirect correlation of the metrics to audit quality. So why are we imposing costly requirements on an entire profession and indirectly public companies for negligible investor benefits? Unfathomably, I do not clearly see where our economic analysis points to adequate supporting evidence indicating Main Street investors are asking for these metrics. As many are aware, I have repeatedly expressed concerns about the disproportionate burden we are placing on small firms. A community of small and medium firms submitted a comment letter for the first time ever. The commenter expressed serious concerns regarding the pace and volume of the board's activities and its impact to smaller firms, as well as cites the importance of small companies on capital formation. Specifically, it states that according to the fiscal year 2023 annual report from the U.S. Securities and Exchange Commission, Office of the Advocate for Small Business Capital Formation, 99.9% of all businesses are small businesses. 43.5% of the U.S. GDP is created by small businesses, and 63% of net new jobs are created by small businesses. And smaller accounting firms are deeply rooted in the local communities they serve. As I have stated on many occasions, small firms are important to our capital markets ecosystem. This adopting release will add tremendous strain on personnel and financial resources of small firms. On a broader level, the collective implementation of all the new PCAOB standards will detract focus from audit quality. Commenters share my views on the negative impact on smaller firms. For example, a commenter expressed concerns regarding the disproportional burden on smaller firms, noting that the cost burden will likely accelerate the exit of smaller firms from conducting public company audits. My professional skepticism leads me to wonder if this adopting release is a thinly veiled tactic to create more avenues for inspection findings so that the PCAOB can rejoice in record-setting enforcement actions and civil money penalties. For these reasons, I do not support this adopting release. I want to thank the staff for their hard work, particularly since they have been under intense pressure to rush to get this done. That should not have been the case. I now have a few questions for the Chief Auditor and the Chief Economist. Ms. Verich, are you aware of any proposals adopted by PCAOB Board in less than 226 days?
Thank you for your question, Board Member Ho, but I don't want to misspeak, and I've not had the opportunity to calculate the number of days. We do seek to get final rules correct. One of the rulemakings you did not mention in your statement was non-compliance with laws and regulations, which the board delayed getting out because we want to get it right.
Great. It's okay that you don't know, but I do. I have analyzed our rulemaking docket data. The only proposal with more than 46 comments adopted in less than 226 days in the history of PCAOB was Auditing Standard 2. It was adopted in 153 days, and then it had to be amended 3 years later after a disastrous rollout and public outcry. My second question, was any follow-up outreach conducted with the institutional survey, investors survey?
Which survey are you referring to?
A commenter submitted a survey of institutional investors and also audit committee members. So my question is, did we perform any follow-up to understand the data better or learn more and do more additional outreach?
Not with respect to that survey. We read the comment letter, we read the survey, and we considered the merits of the comments and the information as part of our recommendation. And I'd also like to mention, with respect to the timing of rulemaking, not all rules are the same. And I also think it's important to note that rulemaking sometimes are delayed for reasons other than the number of comments received. Thank you.
Thank you. So why didn't we conduct any additional outreach to understand the data more?
The staff did not feel it was necessary.
Okay. All right. Well, in terms of the cost, the adopting release states that producing the metrics will not be overly costly and burdensome. What is your definition of costly?
Are you directing that to me or are you directing
Yes,
that to?
yes, I am.
I don't have a definition of costly. I defer the considerations of costs and benefits primarily to the economists. However, I will say that the staff's recommendation, I think, reflects concerns that commenters raised. We were cautious with what we've included in the final recommendation, and I believe that much of the information is already collected with respect to hours. As you noted, training data is important for state licensure. So if CPAs and firms are already collecting that information, for example, many firms track hours. With respect to metrics like industry experience, there would only be a one-time cost to collect that information, and then the firm would be able to roll it forward with little effort going forward.
Yeah, so our economic analysis provided an extrapolated cost of 67 million, not including system implementation, and 512 million if the system have to be built from the ground up. Would those be considered costly?
I'll defer to
67
Martin
million
Schmaltz
or
on that.
512
Those aren't my estimates,
costly?
so I think it'd be better for him to discuss them. And I think they may be better with some context around those numbers.
Okay, I'll get to him in a minute. So last question. Would it be burdensome for your staff to report hours on an individual standard setting basis for a cost accounting purpose?
It would not. We already collect that information through our timekeeping system and have done so in a granular fashion for a number of years.
Okay. Well, thank you.
Thank you.
Mr. Schmaltz. The economic analysis lists the direct benefits as follows. The direct benefits of the final rules related to improve investor and audit committee monitoring, 2, improve auditor selection, and 3, improve PCAOB oversight and scholarly auditing research. It also references a study where the benefit of comparable information have been observed in financial reporting. However, many commenters expressed concern that the metrics would not be comparable or may be misunderstood. So my first question, what specific monitoring activities do you anticipate investors will perform over auditors?
Thank you for the question, Board Member Ho. So investors ratify the auditor and they vote on board members' selections, and they are more informed thanks to these metrics in important dimensions than they would be without them. That is the benefit. They can also move their capital if they disagree with the choices. This can reflect in equity prices, and thus this allows for a more market-based incentive system for audits. So this has the potential to improve governance along all of the dimensions, along voting, along shareholder voice, as well as exit, so moving the capital away from firms.
So you expect investors to be looking at these metrics and comparing them, and then when they're about to vote, that they will use it to decide how they're going to ratify the auditor selection, which is not legally binding, and also monitor the audit committee.
That is correct. That is my understanding from how institutional investors in particular think about auditor ratification.
So that means that it is very important that our data to be high quality, the metrics has high quality. Would you agree?
Higher quality data seems to be beneficial to improve decisions, yes.
Okay, and then that they be comparable, because if they're not, then it would not be informative to their decision, right?
Yeah, I think you referred to the comment letters that pointed out the necessity to clarify the definition, and that's exactly what we did in the adopting release to meet that demand.
So what evidence did you contemplate in considering the comparability of the metrics data across varying size firms and varying size engagement?
So in order to compare, say, the number of partners relative to juniors or any across the metrics compared to an average of industry competitors of the issuer, that can be done with the metrics we construct. That is a matter of arithmetic rather than evidence. Of course, there does not exist direct evidence in the academic literature on the particular metrics we propose to adopt for US capital markets, given that they have not been adopted yet.
Okay, well, I think we should have more offline discussion, since I know that I am throwing this question at you, Cole, because of the rush. So this
I'm
next
always at your
question I have,
disposal, and flexibly so.
do you believe in the value of post-implementation reviews?
I do.
So some commenters suggested that the PCAOB adopt a specific plan to conduct post-implementation reviews. As referenced in the economic analysis, unfortunately, the adopting release will not commit to a post-implementation review, and states that under the established post-implementation review program, the board expects that the staff will consider whether, based on these factors, a post-implementation review might be warranted, and if so, staff will recommend that the board determine to conduct one. In other words, this deliberation should take place without any commitment. So will you commit to doing a post-implementation review as suggested by the commenters?
We considered that comment by commenters like all the other comments in our economic analysis and came to the conclusion that our established protocol is ideally suited to respond to that question. Pre-committing to a PIR and specific designs itself has effects that would bias the analysis potentially. And for these reasons, we leave it for future boards to determine whether they want to conduct a PIR, but we will certainly inform the board about our opinion on when and how that should be done according to the established protocols.
I find this a very hypocritical position, because on one hand, we're invasively requiring firms to publicly disclose volumes of firm and engagement information where the direct linkage to audit quality is questionable, while on the other hand, we're unwilling to conduct a review on the actual efficacy of this new standard. So my last question.
May I just respond to that? It is not that we're unwilling to conduct the analysis. I thought I just said very clearly that we are willing to conduct the analysis.
Okay, that's good. I had previously referenced in my statement part of the Congressional Review Act's definition of major rule. Can you tell me if this rule is likely to result in an annual effect on the economy of 100 million or more?
No.
No, that you cannot tell me, or that no, it will not result in 100 million?
No, I cannot tell you that. It is not possible based on the analysis we conducted to come to that conclusion.
Okay, well, I would like to have a follow-up discussion on that because since we said it's on one hand, based on the CAMP, the extrapolated cost is estimated at 67 million without the system implementation. And then that's and 512 million when system had to be built from the ground up. So
that is, I would like to say, put for the record that this is incorrect. So there are various if statements associated with that. And as the chief auditor pointed out, these if statements are unlikely to hold true in practice because firms already have these systems in place. So these calculations, as we explained in the economic analysis, serve as an upper bound of the possible costs, but they are not an estimate.
okay, that's the word that is in the economic analysis that we are estimating. So, and also the economic analysis also said that it's difficult to get an estimate. So that's why you're providing these extrapolated costs. But again, that's all my questions. Thank you. Back to you, Chair Williams.
Thank you. Board Member Stein, the floor is yours.
Thank you, Chair Williams. Good morning, everyone. Today, we're considering a staff recommendation that would require audit firms to report 8 sets of metrics each year. Under the rule, firms would report at both the firm and, more importantly, at the engagement level, the following: the involvement of partners and managers in the audit, partner and manager workload, training hours, audit experience, industry experience, and allocation of audit hours prior to and after year end. Firms would also report at the firm level only metrics about the retention of audit personnel and number of restatements. Importantly, the rules would apply only to audits of SEC accelerated filers and large accelerated filers, and to firms that audit at least one such filer. This rule is a groundbreaking advance. For the first time, it requires the provision of core information that can help investors, audit committees, and the capital markets understand more about audit performance. By mandating the disclosure of this information, the PCAOB will enable investors and other market participants to have a clearer and more comprehensive view of the operational practices of the registered audit firms that audit public companies and broker-dealers. Both investors and audit committees have vitally important roles to perform in the audit governance process, but they often lack the information necessary to perform those roles effectively. That is because auditing is basically a credence good. Its operation is hard to observe and its qualities hard to evaluate. The information flow created by these new metrics will provide consistent and comparable information on auditors and audit engagements, on what auditors do and how they do it, to help with the credence good problem. It will not create a magic formula for assessing audit quality, especially the critical qualities of independence, due care, and professional skepticism. However, it can help us understand the environment that fosters or harms those qualities. I hope that firms will use the comment space provided to deepen users' understanding of the information. Reported information will also inform our oversight activities, especially our inspection and standard setting programs. And for audit firms themselves, metrics will provide standardized information about their own firm and their peers that can be used in designing, implementing, monitoring, and remediating their systems of quality control. For all of this to occur, reporting must be at the engagement and firm level. Investors care about the companies they are invested in, companies in which they vote for the directors and they ratify the appointment of the auditor. Audit committees oversee the audit engagement for a particular company. Firm-wide information can help frame engagement information, but it cannot be a substitute for it. By mandating the disclosure of this information, the PCAOB will enable investors and other market participants to have a clearer and more comprehensive view of the operational practices of the registered audit firms who are auditing our public companies and broker-dealers. This enhanced transparency will allow market participants to make more informed decisions, contributing to the integrity and reliability of both audit practices and financial reporting. Again, if adopted, this disclosure rule can produce a fundamental change in the environment in which participants in the audit process operate. I want to note that this is one of the PCAOB's longest pending projects. Its seeds were planted by the recommendations of the Treasury Advisory Committee on the Audit Profession in 2008. The board's former Office of Research and Analysis prepared a concept release issued in 2015, 10 years ago, which led to the issuance of a proposed metric rule in April of this year. This rule represents the culmination of nearly 10 years of work. Like QC 1000, it was a subject of concentrated effort. Its content matured over time, and it was not brought to the board until the work was done. I would like to thank all the staff at the PCAOB who worked on this project. Specifically, I would like to recognize in the Office of the Chief Auditor, Jessica Watts, Stephanie Hunter, Karen Wiedemann, Claire Sevier, Skylar Sims, and Akiko Upchurch. In the Office of Economic and Risk Analysis, Eric Durbin, Nick Galunik, Eric Carlson, and Josh White. And in the Office of General Counsel, Connor Rasso, Catherine Kelly, Vince Meehan, and Mark Francis. I would also like to recognize the support provided by staff from the Division of Registration and Inspections, the Division of Enforcement and Investigations, the Office of International Affairs, and the Office of Communications and Engagement. I also would like to thank the Securities and Exchange Commission staff, including the staff of the SEC's Office of the Chief Accountant, for their support and assistance. Finally, I would like to recognize Greg Jonas, who as Director of the Office of Research and Analysis led the original effort that produced the 2015 concept release, and the 3 remaining PCAOB staff members who worked on that release, Jane Hutchins, Steve Kroll, and George Wilford. I am pleased to support the staff recommendation, and I will now turn the mic back over to Chair Williams.
Thank you. Board Member Thompson, the floor is yours.
Thank you, Chair Williams. With this adopting release, we take a pivotal step towards increasing audit transparency in the interests of investor protection. I would be remiss if I did not take the opportunity to tie this achievement to our strategic plan. We set out to adopt standards that meaningfully improve audit quality and to increase transparency. This project achieves both goals. I'd like to reflect on how this adopting release answers 3 questions. Why are metrics important? Can metrics be understood by investors? Was there enough time devoted to this project? Let's start with why are metrics important. Quantitative metrics about the audit are important for transparency and trust, cornerstones of our capital markets. Metrics are more than just numbers. These metrics will provide insights into the relevant aspects of the audit, such as involvement by those in charge of supervision and review, workload, training hours, career experience, industry expertise, retention and phasing of the audit, and restatement history. Public accounting firms operate in a highly dynamic and competitive environment where trust, transparency, and accuracy form the foundation of their audits. Understanding and leveraging key metrics can further enhance investor trust by pulling back the curtain on the inputs to and results of an audit, particularly with the way that the firms and their staffs conduct the audit. Much of this information is already captured by large firms who publish firm-level metrics. With mandatory reporting, it drives consistency in definition and calculation across relevant firms. What is particularly defining with this release is that 6 of the 8 metrics are required at the engagement level. This is a level of transparency into the audit rarely provided before to investors. As one investor told me, anything more than 0 metrics is more than we have today. With these metrics, investors will now receive consistent information which builds trust. And the ability to compare metric trends over time will further increase the power of the metrics, especially when paired with the optional narrative disclosure that firms are permitted to include in the new and revised form reporting. In short, firm and engagement metrics will revolutionize the transparency of the audit and deepen the trust within our capital markets. Next question, can metrics be understood by investors? Investors have been clear. They want additional insight into the audit, and they are not confused by metrics. Informed investors can improve the efficiency of capital allocation decisions in our U.S. capital markets. Through our advisory groups and comment letters I received, I would summarize that investors absorb complex information and data sets regularly for proxy voting and capital allocation decisions. This includes intricate financial statements, forecasts, microeconomic indicators, industry trends, risk factors, and more. Currently, they receive little to no information regarding key aspects of the audit. Outside of CAMs, which are 1 or 2 on average per engagement, the audit process is rather opaque for investors. Collection of qualitative data to inform capital allocation decisions is important to investors, in particular institutional investors. Including additional information in the form of metrics into their analysis seems appropriate and aligned with current infrastructures. To suggest they may be confused diminishes their existing skill set for extensive analysis on already publicly available information. And was enough time devoted to this project? In other forums, I've reflected on the length of our standards setting and rulemaking projects. For this project in particular, it seems appropriate to reflect on the extensive work and stakeholder input. This board did not start with a blank sheet of paper. This adopting release reflects more than a decade of work and input from various stakeholders in providing investors more insight into the audit. As mentioned in this release by my fellow board member, this journey began 16 years ago with the U.S. Department of Treasury's Advisory Committee on Auditing Profession, referred to as ACAP, including the 6 October 2008 ACAP final report. This final adopting release reflects deliberations and input from the following: our prior standing advisory group meetings between 2013 and 2017, 50 comment letters on concept released on audit quality indicators issued in 2015, voluntary reporting on firm level metrics by some firms, recommendations from PCAOB's Investor Advisory Group between 2017 and 2024, extensive research activities both internally and externally, the initiative of international regulators, and 46 comment letters on proposing release issued in April of this year. The adopting release was derived from current and prior staff work. It reflects more than a decade of extensive research, outreach, and evaluation of stakeholder views. The public had multiple opportunities to provide input and perspectives, even after comment periods ended. This adopting release was improved by various perspectives shared. In particular, the scope of the metrics was appropriately narrowed to the measurement of 8 relevant areas with 2 metrics only required at the firm level. The optional narrative disclosure was expanded from 500 to 1,000 characters, and phased-in reporting is permitted for smaller audit firms. Our standard setting process for this project was deliberate, highly researched, extensive, and evaluative of the last 16 years. Through this adopting release, we advanced transparency and trust in the audit, recognize and validate investors' need for additional information, and demonstrate our commitment to evaluating diverse stakeholder perspectives. Now, I'd like to thank those for the hard work to individuals to include putting together today's adopting release, the Office of Chief Auditor, Bob Vantage, Jessica Watts, Stephanie Hunter, Karen Wiedemann, Claire Seaver, Akiko Upchurch, Skylar Sims, and the Office of Economic and Risk Analysis, Martin Schmaltz, Luke Galanich, and in the Office of General Counsel, Connor Asso, Catherine Kelly, Vince Meehan, Mark Francis, and I could not forget the leader of OGC, James Capoli. I would like to express my gratitude to all PCAOB staff who have contributed to this project over the past 16 years, including those who contributed to the AKI concept release, preparations for prior advisory group meetings, research prepared by PCAOB economic fellows, and the proposing release. Lastly, I thank you, staff of the SEC, Office of Chief Accountant, and my fellow board members, their staff, and my staff. Thank you, Chair Williams.
Thank you. Board Member Bodick, the floor is yours.
Good morning, and thank you, Chair Williams. I am pleased to support the adoption of firm and engagement metrics. As I noted in my statement in support of the proposal, this is a project many years in the making, and my time at the PCAOB has given me a front row seat to its development. I was a staff member in the Division of Registration and Inspections in 2008 when the Treasury's Advisory Committee on the Auditing Profession, or ACAP report, first recommended developing indicators of audit quality. And I remember distinctly the many conversations that ultimately led to our own 2015 concept release, with Greg Jonas leading a dedicated team in this effort. More recently, our Investor Advisory Group and our Standards and Emerging Issues Advisory Group have discussed the topic at multiple meetings and provided valuable input and perspectives. That history, as acknowledged in the release, underscores how strongly investors and other stakeholders have sought this type of information. In my estimation, the topic of quantitative indicators or metrics around the financial statement audit has one of the most well-developed bodies of thought, discussion, and scholarly research of any potential topic in auditing. The rule before us today has literally been over 15 years in the making. Because of this rich history, I have spent many years contemplating the value of audit quality indicators, or what we now call metrics. This includes studying firm-level metrics disclosed by many firms in their annual quality or transparency reports, as well as the work of numerous non-U.S. regulators in this space. I see firm and engagement metrics as the latest step in a long series of efforts of the PCAOB to provide insight and transparency into the audit process for the investing public, for audit committee members, for the academic community, and for other stakeholders. Other steps in this journey have included Form AP, which requires the disclosures of the names of engagement partners and other accounting firms who participated in the audit, and Critical Audit Matters, or CAMs, which cover challenging, subjective, or complex matters of auditor judgment conveyed to the audit committee. The collective transparency offered by these endeavors is essential. I will say without hyperbole that it represents the democratization of the audit process, With this change, every investor, director, academic, firm employee, or partner will have access to the same body of information. Previously, this information may only have been shared with the audit committee and management, only for that engagement. The availability of this information, in turn, promotes the trust and confidence in the auditor's work that is essential to the continued healthy functioning of the capital markets. At its core, an audit is about risk assessment and the planning and execution of audit procedures. Both activities require a great deal of professional judgment, which can be difficult to assess from the outside. These limitations hinder stakeholders' ability to assess the quality of the audit, and in turn, any related decisions are also hindered. Audit committee members are well placed to ask questions of their own auditors about their own audit. But as one commenter on the proposal pointed out, an audit committee's principal tool is inquiry, not observation, which in audit parlance is the weakest form of audit evidence. Furthermore, for other engagements, even audited by the same firm, audit committee members have no greater visibility than any other user of the financial statements. When one audit cannot be differentiated from another, investors and other stakeholders are left looking at broad variations in firms and their reputations, which may or may not correlate with quality and do little to inform the work performed on a particular set of financial statements. That is one reason why I am so pleased that the metrics before us today are assessed at both the firm and engagement level. As noted in the release, our oversight activities have revealed that there are identifiable performance differences both across firms and even among engagement teams within the same firm. To serve their intended purpose, metrics are needed at both levels. Firm-level metrics provide insight into the manner in which firms manage and deploy resources, and engagement-level metrics demonstrate the execution of those efforts on individual audits. The disclosure of both firm and engagement-level metrics will enable audit firms to differentiate their audit work and truly be able to compete on quality. When doctors need to examine the workings of a patient's heart, they generally do not cut the patient open. Instead, they order an echocardiogram, which uses sound waves to generate a picture of how blood is flowing through the various valves and chambers. I believe these metrics, when combined with Form AP information and CAMs, offer a similar echo of the audit process that investors, audit committee members, the academic community, and other stakeholders can examine and glean valuable information from to form conclusions about the audit. This suite of 8 metrics primarily focuses on information about audit personnel and will provide valuable insights into the audit process. Of these metrics, I am pleased that training hours have been added since the proposal. Although shared service centers and the use of specialists are no longer included, I am pleased the release acknowledges the expanded and evolving use of shared service centers and the commitment of PCAOB staff to study the impact of shared service centers on audit quality, on financial economics, and on staffing models. While no set of metrics, no matter how carefully articulated, can fully capture the inner workings of an audit, the staff have worked diligently to distill over 15 years of organizational efforts, recent commenter input, and significant work from the academic community to arrive at today's recommendation. In turn, I look forward to the scholarly research the academic community will perform from the information provided by these metrics moving forward. I anticipate such efforts will lead to new information about the financial reporting ecosystem that will help improve audit quality even more. Such efforts will only serve to benefit our understanding of the drivers of audit quality. I believe transparency into the audit process is of paramount importance if the audit is to remain relevant in the long term. In recent remarks, I called auditors the moral backbone of the capital markets, and I fully believe that. But for auditors to continue to be perceived as by the broader public, we must ensure that audits remain understandable along the dimensions that investors and other stakeholders identify as most important. Otherwise, I fear auditors will be viewed as interchangeable commodities where price is all that matters. When firms compete on audit quality, not just price, it preserves their standing as the foot soldiers of integrity. My hope is that firms and audit committees will openly and actively embrace the opportunity afforded by transparency efforts like this one. Doing so will serve the profession for years to come and further solidify trust and confidence in the financial reporting ecosystem. Over the past year, as I have reviewed and considered all the staff's rule and standard recommendations, I reflect on whether a given standard or rule will stand the test of time. I believe all regulators strive for rules that will do just that. In this instance, I am confident that the increased transparency and comparability that these metrics will provide into the audit process will better inform stakeholder decisions, allow firms to compete on audit quality, and will ultimately democratize the audit process. I'd like to thank all the commenters who contributed their thoughts on this proposal. The final standard was enhanced by your feedback. I would also like to acknowledge the many staff members who worked over many years on the various permutations of this effort. And finally, thank you to the staff who worked diligently on this release to get us to today's vote and took the time to meet with me and my staff on multiple occasions. This process was comprehensive and was responsive to our questions and concerns. Thank you to the staff in the Office of the Chief Auditor, the Office of Economic and Risk Analysis, and the Office of General Counsel. I would also like to recognize the support provided from staff in the Division of Registration and Inspections, the Division of Enforcement and Investigations, and the Office of Communications and Engagement. And finally, I want to express my gratitude to my fellow board members and their staff for the many conversations in advance of today's meeting. Thank you.
Thank you. Unless there are any further discussions from the board, I would now call for a vote on the staff recommendation. Board Member Ho.
Oppose.
Thank you. Board Member Stein.
Yay.
Thank you. Board Member Thompson.
Yay.
Thank you. Board Member Bodick.
Yay.
I also support the recommendation, and the recommendation is approved with Board Member Ho dissenting. The next order of business before the board today is a staff recommendation that the board adopt amendments to the reporting requirement for registered firms. To present the staff's recommendation, I will turn to our General Counsel, James Capoli.
Good morning, Chair Williams and board members. The Office of the General Counsel is pleased to recommend that the board adopt amendments to the rules and forms governing the PCAOB's periodic and special reporting framework for registered public accounting firms. The Sarbanes-Oxley Act requires that registered firms submit a public annual report to the board and provides that firms may be required to report such other information as the board may specify as necessary or appropriate in the public interest or for the protection of investors. The board first adopted its periodic and special reporting framework implementing the statutory mandate in 2008 and has not substantively updated it since that time. Today's recommendation grows out of approximately 15 years of PCAOB experience with the current reporting framework, and the recommendation is also importantly informed by developments in the transparency reporting landscape, the ACAP final report, PCAOB advisory group input, and academic research. Lastly, we have received substantial public comment on the firm reporting proposal issued last April, and the staff has spent months considering that comment in connection with this project. The recommended amendments would require more public reporting about key aspects of registered firms' operations that could impact firms' ability to conduct quality audits. We believe that such reporting will be informative and useful to investors and audit committees and will importantly inform the board's regulatory functions, thus improving the board's protection of investors. In just a moment, I will invite Catherine Kelly and Mark Francis to present an overview of the recommendation. Before doing so, though, I want to recognize several people who made significant contributions to this project. From the Office of the General Counsel, I want to recognize and thank not only Catherine and Mark, but also Connor Rosso and Damon Andrews for truly terrific work and collaboration. From the Office of Economic and Risk Analysis, I want to thank Martin Schmalz, Eric Durbin, Dylan Rassier, and Carrie Von Bose for their partnership and support. From the Office of the Chief Auditor, I want to thank Jessica Watts, Karen Wiedemann, Lynette Kleindenst, and David Ellum for their assistance. From the Division of Registration and Inspections, I want to thank Christine Gunia, Tim Sykes, Carol Swaniker, Michael Stevenson, Alan Kerwin, Pamela Robinson, Eugene Theron, Kathleen Ostaszewski, Kevin Taylor, and Abina Glasgow. And from the Division of Enforcement and Investigations, I want to thank Kristen Van Fossen, John Abel, Kira Armstrong, Brett Collings, and Tina Bell. I also want to thank the staff from other offices and divisions, including the Office of International Affairs and the Office of Communications and Engagement, each who have provided assistance with this project. And lastly, of course, I want to thank the Securities and Exchange Commission staff, including the staff in the SEC's Office of the Chief Accountant for their support and timely assistance with this project. Catherine Kelly and Mark Francis of the Office of the General Counsel will now provide an overview of the recommendation, and then Martin Schmalz and Dylan Rassier of the Office of Economic and Risk Analysis will provide some additional remarks before Mark closes with our recommendation. Catherine, I will now turn it over to you.
Thank you, James. And good morning, Chair Williams and board members. The firm reporting amendments would require enhanced public reporting of firm governance, network, and fee information, among other topics, to enhance audit firm transparency. It would further require non-public reporting to the PCAOB of financial statements by the largest firms, non-public special reporting by annually inspected firms of material events that may affect firms' ability to conduct audits, and non-public special reporting of significant cybersecurity incidents to help ensure the PCAOB is aware of significant events affecting the firms it oversees. The proposed requirements were intended to facilitate more complete, standardized, and timely reporting by registered public accounting firms. In formulating the final amendments, we've had the benefit of substantial public comments on the proposal. After considering comments, we are recommending further tailoring of the firm reporting requirements to help ensure the final amendments are workable for firms and achieve the board's regulatory objectives. As Mark will describe in greater detail, we are recommending modifications to the proposed reporting items to streamline and clarify them, and to focus on specific disclosures that would be most useful to the PCAOB in its oversight of audit firms and to investors and audit committees in their decision-making and evaluation of audit firms. We think the result is a balanced recommendation that would modernize the current reporting framework, enhance the information available to investors and audit committees, and improve the PCAOB's oversight of registered firms. With that, I'll turn it over to Mark, who will give an overview of the particular requirements.
Thank you, Catherine. I will now present a summary of the final amendments in each category of required disclosures. With respect to the reporting of financial information, we are recommending a requirement for the largest firms to provide financial statements to the PCAOB confidentially, as proposed, but we recommend eliminating the proposed requirement to prepare financial statements in accordance with an applicable financial reporting framework such as GAAP. Instead, the final amendments prescribe certain minimum requirements for the financial statements. This change is to mitigate the costs of this requirement for firms while still ensuring the reporting requirement improves standardization and improves the board's insight into a firm's practice, focus, and incentives. Next, with respect to governance disclosures, we recommend that the board adopt requirements to increase reporting regarding a firm's leadership and governance structure, including certain key quality control roles, but also recommend modifications to streamline the proposed requirements, increase clarity, and further focus requirements on the registered entity's audit practice. For example, the final amendments would eliminate the proposed requirement for firms to report all direct reports to the principal executive officer to mitigate any issues regarding the disclosure of personal identifying information for individuals whose names and positions may not otherwise be publicly disclosed, and whose positions may not be sufficiently germane to the audit practice to merit public reporting. Next, we have network information. We are recommending amendments to enhance reporting regarding a firm's network relationship, if any, but also recommending adjustments from the proposal to streamline the requirements, increase clarity, and further focus requirements on the registered entity's audit practice and its relationship to the network. For example, instead of asking for the legal and ownership structure of the network and network-related financial obligations of the registered firm, the final amendments ask the firm to provide a brief description of the network structure and the registered firm's relation to the network, including the registered entity's access to network resources such as methodologies and training, among other information. I will now turn to the reporting of certain special specified events. We are recommending a material event reporting item to require information regarding events at the firm that may affect its ability to conduct audits, including solvency-threatening events. But we are recommending modifications from the proposal to clarify ease implementation, and better focus the requirement on information relevant to a firm's audit practice. In addition, the final amendments would limit the firms subject to the material event reporting requirement to those that are annually inspected. So, those firms that provide opinions for more than 100 issuers annually. Moreover, we recommend not adopting the proposal to accelerate the Form 3 reporting deadline for existing special reporting items. Material events, however, would still be required to be reported under the proposed accelerated timeframe of 14 days. This change is intended to ease the burden, particularly for smaller firms, while still requiring timely reporting of events of sufficient significance and urgency to warrant more prompt reporting. Next, for the reporting of significant cybersecurity incidents, we are recommending that the board adopt the proposed requirements to report significant cybersecurity incidents to the board within 5 business days, with modifications to language for clarity and to better link disclosures to the firm's audit practice. For example, we would now define significant cybersecurity incidents as those that have significantly disrupted or degraded the firm's operations critical to the functioning of the audit practice, or those that have led to unauthorized access to the electronic information, communication and computer systems or similar systems, and networks of interconnected information systems of the firm in a way that has resulted in substantial harm to the audit firm's critical audit-related operations. This new definition removes the reasonably likely threshold that existed in the proposal and only includes events that have actually impacted a firm's audit practice. In addition to cybersecurity incident reporting, like I just described, we believe that investors, audit committees, and the PCAOB would benefit from information regarding a firm's policies and procedures related to cybersecurity risks. Such disclosure remains consistent with the proposal. Next, we are recommending that the board adopt the proposed requirement for firms on a one-time basis to report an updated description of QC policies and procedures. Specifically, any firm that registered with the board prior to the date that QC 1000 becomes effective must submit an updated statement of the firm's quality control policies and procedures pursuant to QC 1000 on new form QCPP. And last, the staff is recommending additional time as compared to the proposal for compliance with the rules. So here, for the largest firms, the rules would come into effect as of March 31st, 2027, or 2 years after approval of the requirements by the SEC, whichever occurs later. The second phase, which would begin reporting 1 year after the first phase, would cover the remaining firms subject to these reporting requirements. And with that, I'll pass the mic to Martin for his team to say a few words about the recommendation.
Thank you, Mark. Good morning again, Chair Williams and board members. The Office of Economic and Risk Analysis has performed an economic analysis of the amendments to the board's rules that the board is considering today. The economic analysis includes establishing a baseline of firm reporting under today's rules, identifying a need for rulemaking, evaluating the economic impacts of the amendments, and assessing reasonable alternatives. We appreciate the input of commenters on the proposing release for this rule and have carefully considered the information provided to us through the notice and comment process in developing the economic analysis for this adopting release. We believe the economic analysis contained in this release even-handedly sets out the likely economic effects of the rule. I will now turn it over to Dylan Rassier to present the details of our analysis.
Thank you, Martin, and good morning, Chair Williams and board members. Investors and audit committees currently encounter persistent opacity regarding audit firms' capacity, incentives, and constraints to provide quality audit services. This opacity presents a risk that investors and audit committees will not have decision-useful information in the selection and monitoring of an audit firm. While audit committees can and do request and receive information directly from firms, the information lacks standardization and the information is not directly available to investors for their own voting and monitoring purposes. In addition, PCAOB staff experience with the existing reporting framework has revealed incomplete or imperfect information regarding certain material events at some audit firms, which impairs the board's ability to perform its statutory oversight function. The final firm reporting rule will enhance transparency of audit firms by mandating public disclosure of firm information that is standardized across firms and over time, and will aid investor and audit committee decision-making. The final rule will also require annually inspected firms to confidentially report material specified events, and will require the largest firms to confidentially report annual financial statements, which will provide the board with timely information to perform its statutory oversight function. We have analyzed the benefits and costs of the required disclosures and confidential reporting. Audit committees will benefit from the enhanced information by being enabled to more efficiently and effectively review and compare information across audit firms in their appointment decisions and monitoring efforts. Investors will benefit by being enabled to more efficiently and effectively evaluate and compare firms in their decisions to vote on auditor ratification and oversee the audit committee. Standardization of the reporting requirements will decrease investors and audit committee search costs and monitoring costs by providing consistent and comparable disclosures across firms and over time. The reporting requirements will also enhance the effectiveness of PCAOB statutory oversight, which will benefit investors and firms through more effective use of inspection resources, more effective standard setting and rulemaking, and better informed assessments of material specified events. Firms will incur infrastructure costs and compliance costs to implement the reporting requirements. Infrastructure costs will include building new or updating existing systems for data collection, reporting processes, controls, and documentation. Compliance costs will include personnel costs to prepare, review, and certify filings. There will also be related costs to train personnel. In response to comments, the final reporting requirements have been tailored as compared to those in the proposal, which we expect will help mitigate costs, especially for smaller firms. The tailoring includes reducing the disaggregated information required for fees, reducing or refining the reporting requirements for governance and network information, eliminating accelerated filing for existing Form 3 specified events, eliminating the requirement that confidential financial statements be compiled in accordance with an applicable financial reporting framework, and exempting smaller firms from confidentially reporting material specified events. I thank our PCAOB colleagues in the Office of the General Counsel, the Division of Registration and Inspections, and the Division of Enforcement and Investigations, and the SEC staff for their support in developing the economic analysis. I will now turn it back over to Mark to present the staff's recommendation.
Thank you, Dylan. In closing, the staff is recommending that the board adopt the final rules and form related to firm reporting and issue an accompanying adopting release in substantially the form before you. Instruct the staff to submit the final amendments to the SEC on Form 19B4 for the Commission's approval pursuant to Section 107B of the Sarbanes-Oxley Act, and request that the Commission determine, to the extent that Section 103A3C of the Sarbanes-Oxley Act applies, that the application of the amendment to the audits of emerging growth companies is necessary or appropriate in the public interest after considering the protection of investors and whether the action will promote efficiency, competition, and capital formation. Thank you very much.
Thank you, James, Catherine, Mark, Martin, and Dylan. At this time, my fellow board members and I will have an opportunity to make a statement or ask questions to the staff. We will proceed in the order of seniority, and I will begin. With this recommendation, we are considering a set of amendments to the PCAOB's firm reporting requirements. With these amendments, the PCAOB is taking action to have the necessary information to execute our regulatory process with more consistent, complete, and comparable information from audit firms, and to provide greater transparency to investors and audit committee members. The PCAOB's annual and special reporting requirements for collecting and publishing information from firms has not been substantially updated since 2008. And as with the Firm and Engagement Metrics project, several of the overarching themes and concepts in the firm reporting amendments were originally outlined in the U.S. Department of Treasury's Advocacy Advisory Committee on the Auditing Profession Report in 2008 under President Bush. To put it another way, the PCAOB is carrying forward recommendations that have been talked about for 16 years. These amendments were proposed by the board in April of this year. Our expert staff has now studied the comments that we received from the public and recommended that we adopt the amendments. And that is why we are here today. These amendments reflect lessons learned through years of work by the expert PCAOB staff, and if adopted, would amend the annual and special reporting requirements and facilitate the disclosure of more complete, standardized, and timely information by firms, such as enhanced fee, governance, and network information. More specifically, today's amendments enhance firms' required current reporting of information on the PCAOB's public annual report form known as Form 2 and the special reporting form known as Form 3. The changes under the final rules cover 6 key areas. First, financial information. If adopted, the amendments will require all registered firms to publicly report additional fee information so that reported fee information will be more useful to users of the annual report form. The largest firms will also be required to confidentially submit financial statements to the PCAOB. These firms play an essential role in our capital markets and overall economy. The PCAOB already collects certain information once an audit firm is in bankruptcy or receivership. However, by that point, especially for the largest firms, there would be a significant disruption in the auditing market, giving the PCAOB little time to consider the ramifications of other firms being able to comply with PCAOB standards as they engage with new clients. Second, leadership and governance information. Under the final rules, all registered firms will be required to report additional information regarding their leadership, legal structure, ownership, and other governance information, including reporting on certain key quality control, operational, and oversight roles. Firms' leadership and governance structures have a direct impact on their incentives and ability to provide high-quality audit services to investors. Third, network relationships. These amendments require registered firms to report a more detailed description of any network arrangement, including describing the network structure, the registered entity's access to resources such as audit methodologies and training, and whether the firm shares information with the network regarding its audits. This information provides a look at the accountability and oversight structure that a firm is subject to via its membership in a network. Fourth, special reporting. Under the final rules, annually inspected firms, of which there are typically 15 or fewer, will be required to file special reports for additional events material to a firm's organization, operation, liquidity, or financial resources. These are the types of events that may directly bear on a firm's ability to conduct audits. Fifth, these amendments require additional reporting related to cybersecurity. There is a general consensus that cybersecurity threats are among the greatest risks in the business world today. As such, these amendments require registered firms to confidentially and promptly report significant cybersecurity events to the PCAOB and periodically and publicly report a brief description of any policies and procedures to identify and manage cybersecurity risks. The last change under these rules requires firms that registered with the PCAOB prior to the implementation date of the PCAOB's new quality control standard, which is December 15, 2025, to submit an updated statement of the firm's quality control policies and procedures pursuant to the new QC standard. This is a one-time reporting obligation to help ensure information regarding a firm's QC system is current. Together, these changes will arm investors and audit committee members with even more information to make informed decisions about audit firms and will enable the PCAOB to better execute its investor protection mission. The PCAOB takes public comment and feedback very seriously. We read each and every comment letter and consider the feedback provided. After the board put forward this proposal in April, we received insights that helped to craft the rules before us today and ensure that the requirements are useful to PCAOB staff, investors, audit committees, and others. I would like to highlight some of the changes reflected in the recommendation we are voting on today that resulted from feedback received in comment letters. The final recommendation streamlined fee disclosure requirements to provide the most useful information to the public and make it easier for firms to report that information to the PCAOB. It eliminated the originally proposed requirement that financial statements conform to an applicable financial reporting framework such as GAAP, and instead the financial statements must now meet certain minimum reporting requirements that will serve our regulatory needs. It streamlined the requirements related to firm governance and network arrangements. It eliminated the proposed acceleration of the special reporting deadline for existing special reporting items to make it easier on firms, especially smaller firms, to provide this information. It amended the material event reporting requirement to focus on information relevant to a firm's audit practice and limit the material event reporting requirement to firms that are annually inspected. Today's adoption will help to make the PCAOB's congressionally mandated oversight more effective and provide investors, audit committees, and others with clear, consistent, and actionable data from audit firms. This proposal reflects the meticulous work of our expert staff who collectively have years of experience and expertise in recommending where improvements to existing reporting requirements can be made. The amendments before us today are the result of work from staff across multiple PCAOB audits and divisions, and I commend their careful work on these amendments. As such, I would like to thank the many members of the PCAOB staff who have worked on this rulemaking project, including from the General Counsel's Office, James Capoli, Connor Rasso, Catherine Kelly, Damon Andrews, and Mark Francis. From the Office of Economic and Risk Analysis, Martin Schmalz, Dylan Rassier, and Carrie Von Bose. From the Office of the Chief Auditor, Jessica Watts, Lisa Calandrillo, Lynette Kleindens, and David Illong. And from the Division of Enforcement and Investigations, Kira Armstrong, John Abel, Brett Collings, Tina Bell, and Kristen Van Fossen. And from the Division of Registration and Inspections, my thanks to Christine Gunier, Tim Sykes, Carol Swaniker, Michael Stevenson, Alan Kerwin, Pamela Robinson, Eugene Theron, Kathleen Otasuski, Kevin Taylor, and Abina Glasgow. In addition, I would like to thank my fellow board members and their staff for their engagement and contribution over the last several months on this project. And I would also like to thank the contributions of the Securities and Exchange Commission staff, including the staff of the SEC's Office of the Chief Accountant, for their support and assistance. I will now turn to my fellow board members for any statements they may wish to make or questions they would like to pose to the staff. Board Member Ho, the floor is yours.
Thank you, Chair Williams. In the aftermath of one of the most consequential presidential elections, I could not help but think about the words of another presidential candidate at his nominating convention more than 60 years ago. Quote, "Extremism in the defense of liberty is no vice, and moderation in the pursuit of justice is no virtue." Unquote. I oppose extremism, no matter the cause, because it is inconsistent with the theory of virtue elucidated by Aristotle, who believed that virtue is a mean between excess and deficiency. I believe that extremism errs on the side of excess, whereas virtue calls for moderation. The firm reporting adopting release makes it abundantly clear that the PCAOB believes that extremism in the name of investor and audit committee protection is a virtue and not a vice. The PCAOB believes that no reporting burden is too great for public company audit firms to bear, even if, one, the benefits are speculative, and two, there are no direct linkages to improve audit quality. Specifically, the adopting release states that, in general, we continue to believe that enhanced information regarding audit firms will support audit committees' abilities to efficiently and effectively compare firms in their appointment decisions and monitoring efforts, and investors' abilities to efficiently and effectively compare firms in their ratification decisions and monitoring efforts, and in their capital allocation decisions. The required disclosures will also provide indirect benefits linked to audit quality. Against that backdrop, I want to narrowly focus on 1, audit committees, 2, investors, 3, audit quality, and 4, the cumulative effect of the PCAOB's reporting requirements. First, audit committees. Now, the fact that the language I quoted from the adopting release first mentions audit committees, then investors, and then audit quality is stunning to me. First, it's stunning because the PCAOB statutory mission under Title I of the Sarbanes-Oxley Act of 2002 is to 1, protect the interests of investors, and 2, further the public interest in the preparation of informative, accurate, and independent audit reports. The statutory mission statement does not mention audit committees, and the PCAOB has no statutory authority over audit committees. Moreover, the mandatory reporting requirements the PCAOB is adopting today will not be included in audit reports. To quote a current SEC commissioner, the PCAOB's role is important, but limited. I am concerned that the PCAOB is compromising its mission when it attempts, through these mandatory firm reporting requirements, to expand its reach to other areas, such as audit committees. Second, and perhaps most importantly, the reference to audit committees is stunning because the adopting release does not discuss the 2 comment letters presenting the views of audit committee chairs and members. These comment letters make it clear that audit committees do not support the mandatory firm reporting requirements. The first commenter conducted a survey of audit committee members asking whether the proposed enhanced reporting requirements will be useful to audit committees in exercising their oversight role. Of the 142 audit committee members responding, a nearly supermajority of 63% said no. The second comment letter stated, audit committee chairs do not think the proposed information would enhance their oversight role. I don't find their proposals helpful at all to me as an audit committee chair in the effective execution of my responsibilities. The second commenter also noted that audit committee chairs already receive or have access to most of the information that the proposals would mandate. How can the PCAOB say in the adopting release that it continues to believe that today's mandatory reporting requirements will support audit committees when it fails to specifically mention, much less discuss, the audit committee comment letters? This failure indicates that this midnight rulemaking was rushed. Now, the economic analysis does discuss the audit committee comment letters, but it does so in a result-oriented manner. For example, the economic analysis states that 37% of 142 respondents indicated that the reporting requirements will be useful to the audit committee in exercising its oversight role, and 63% of the respondents indicated that the reporting requirements will not be useful. Those percentages are accurate, but the economic analysis blithely shrugs off the unequivocal views of a near supermajority of 63% of audit committee members who do not believe the mandatory reporting requirements will be useful. First, the economic analysis states that commenters did not explicitly disaffirm the potential uses. If 63% of audit committee members surveyed state that the proposed reporting requirements will not be useful to them, that reads like an explicit repudiation. Ask anyone if they consider a 37% approval rating to be an affirmation or a repudiation. Second, the economic analysis states that the PCAOB does not rule out the possibility that investors or audit committees could have future needs for required disclosures. Third, the economic analysis states that audit committees may come to appreciate the accessibility and comparability of the required disclosures. These latter two statements are patronizing because the PCAOB is telling audit committees and investors that the PCAOB knows better than them about what they need. It's like me telling my child about her piano lessons. You'll thank me later. But the big difference here is the PCAOB is neither the parent nor the regulator of audit committees. Audit committees are not children, and the PCAOB does not know better than audit committees about their current or future needs. I sometimes question whether the PCAOB understands its own current or future needs. So how can the PCAOB tell others what they need? Second, investors. Turning to investors, one comment letter presented investor views in the form of a survey of 100 institutional investors. These institutional investors had asset under management of 500 million or more, of which 41% had 5 billion or more. For example, this survey asked whether certain types of specific information would be extremely helpful. The responses range from 35% stating that network information would be extremely helpful to 37% stating that information on fees would be extremely helpful, to 50% stating that information about a firm's system of quality control management would be extremely helpful. However, the economic analysis acknowledges that the relationship of these percentages to the proposed reporting requirements is ambiguous because the survey questions were not directly tied to the proposal's mandatory reporting requirements. Specifically, the economic analysis states that the 50% figure on the helpfulness of information about a firm's system of quality control did not ask specifically about Form QCPP. This ambiguity and the low percentages of institutional investors finding information to be extremely helpful should have prompted the PCAOB to conduct additional outreach to better understand what institutional investors need and will use, and whether the proposed reporting requirements are narrowly tailored to match up with those specific needs and uses. The PCAOB conducted outreach on its no-CLAR proposal, so doing so here would not have been unprecedented, but that would have taken time. And the PCAOB has decided to rush this midnight rule before it was ready so that it could have another notch in its belt. Never mind the fact that the required disclosures will not directly improve audit quality. 3, audit quality. In my April 9, 2024 dissenting statement, I stated that the proposal contains a significant expansion of reporting requirements, except that here there are no clear and direct linkages between the proposed new reporting requirements and audit quality. I cited language from the proposal's economic analysis stating the proposed disclosures would not have a direct relationship to audit quality. Today's economic analysis says much the same, noting that while the required disclosures will not necessarily have a direct relationship to audit quality, they may enhance audit quality, along with a mouthful of an explanation premised on audit committees and investors actually pouring through the required disclosures. I believe that it is fanciful for the PCAOB to believe that audit committees and real investors will actually use the required information based on the surveys of audit committee members and institutional investors. As I noted earlier, 63% of audit committee members surveyed stated that they did not find the proposed reporting requirements useful, and it's far from clear whether the institutional investor survey are likely to use the reported information. Now, the PCAOB has a mind-boggling response to two commenters who suggested that without a direct link to audit quality, the benefits to investor and audit committees are uncertain. The PCAOB states that investor-related groups and audit committee members affirm the usefulness of the required disclosures. First, the reference to investor-related groups pertains to investor advocates and not real investors, like the institutional investors survey. Second, stating that audit committees affirm the usefulness of the required disclosures is wholly unsupported and contradicted by the two comment letters presenting the views of the audit committee members. 4. Cumulative effect of reporting requirements. In my April 9, 2024 dissenting statement on the proposal, I expressed concern about the board imposing in each new standard or rule burdens on firms without any quantification of the estimated burdens or costs. Illustratively, I also expressed concern about triplicative reporting requirements related to naming a firm's principal executive officer, duplicative in the proposal's amendments to Form 2, and triplicative where we saw the same reporting requirement in then proposed QC 1000. In that vein, several commenters suggested that the PCAOB consider the cumulative effects of the reporting requirements in the proposal along with other standards and rules that have recently been proposed or adopted. The economic analysis swats these comments away like a common housefly by stating that it considers the incremental benefits and costs for a specific rule, meaning it looks at cumulative costs and benefits only on a rule-by-rule basis. Sadly, these words ring hollow when we look at how the PCAOB responds to comments on triplicative reporting. The adopting release states that it has eliminated the duplicative reporting requirement in Form 2 pertaining to identifying the principal executive officer, something that should have never been in the proposal in the first place. So no more triplicative reporting between Form 2 and Form QC. But then the PCAOB justifies the duplicative reporting requirements in this adopting release and recently adopted QC 1000 by stating that such duplication was intentional. We do not believe the reporting of a small number of names is overly burdensome, notwithstanding that firms have to report the names on Form QC and Form 2. This statement is doubly disturbing. First, by stating that the duplicative reporting requirement in this adopting release in the QC 1000 is intentional and not overly burdensome, is inconsistent with what we say in the economic analysis as to how the PCAOB looks at cumulative costs and benefits. Second, it demonstrates not just indifference to commenter concerns about the cumulative effects of PCAOB reporting requirements, but contempt, sheer contempt for commenter concerns. The unbridled contempt conveyed in this adopting release and the corresponding abuse of power convinced me that the PCAOB like most financial regulators, should be subject to congressional oversight because unchecked regulatory power is dangerous and harmful to the capital markets. Such congressional oversight should perhaps include the Congressional Review Act, which is a tool that Congress may use to overturn rules issued by federal agencies. While the PCAOB is not a federal agency, I believe that it could serve as a helpful check on the PCAOB's regulatory overreach. For these reasons and the reasons stated in my April 9, 2024 statement, I cannot support this adopting release. I want to thank the staff for their hard work, particularly since they have been under intense pressure to rush to get this done. That should not have been the case. I now have some questions for the General Counsel and the Chief Economist. Mr. Capoli, you referenced in your statement the previous periodic reporting rules adopted in 2008. Do you recall how long it took to adopt that rule?
I don't, Board Member Ho, because I didn't see that as relevant. Here, we followed a rigorous process, a legal process, and a collaborative process. So there's no infirmities with the process with which the recommendation we formulated is coming to you today. So I don't have that recollection.
Okay. Well, I have, because I have analyzed these data. The periodic reporting rule adopted in 2008 took 749 days from proposal to adoption. And that essentially was 25 months. And actually that rule received 12 comments. And the adopting release, the proposal for this firm reporting, we received 37 comments, 3 times as many. So clearly we have been significantly surpassing that previous time. Now, my next question, was any consideration given to conducting follow-up outreach with the institutional investor survey?
Well, thank you. And those statistics you just provided are interesting. Appreciate that. Catherine, could you please answer that question for the Office of General Counsel?
Yes, thank you, James. We did not perform outreach directly to institutional investors that were surveyed, Board Member Ho, but we did reach out to the commenter that provided the survey data in their comment letters and met with them to discuss their comments.
Okay, so did that result in was that helpful? Did you take that into consideration?
Yes, we consider that along with all of the comments received on the proposal,
and was
which is reflected in the release.
And was that the same for the audit committee member survey?
Yes, I believe that the survey that you're referring to was submitted by the same commenter, and that's the commenter that we met with.
Okay, so you got more information through that discussion, but despite the supermajority of opposing it, we continue to move forward with the mandatory requirement.
Well, in response to that and sort of the comments as a whole, we made numerous changes to the proposed requirements to streamline them and dial back certain components of the reporting requirements as reflected in the release.
Okay. So my next question, the adopting release narrows the scope of firms subject to material event reporting to those subject to annual inspection, which is a positive change. So Mr. Capoli, why are we not doing the same for significant cybersecurity incident reporting?
Well, thank you for that question. And again, for well over 18 months, Senior Associate General Counsel Catherine Kelly has really done impressive work on this project. So I would be remiss to steal the limelight. So Catherine, could you please answer that question?
As an initial matter, we felt that the increased sort of risks from cybersecurity incidents merited a broader reporting scope there, and felt that cybersecurity incidents have the potential, even at a smaller firm, to be disruptive for potentially a number of issuers and investors and other stakeholders.
Okay, so you perceive the cybersecurity risk and the material event reporting to be different at the different risk level.
Yes, I think that both the scoping of those reflects the difference in the reporting requirements and the different intention of those two reporting requirements.
Okay, well, thank you. And that's all my question for for the Office of General Counsel, and I have a question for the Chief Economist. Mr. Schmalz, the economic analysis states that the most recent research from its calendar year suggests that audit partner disclosures in Form AP provide useful information to equity markets, and cite a paper on that. And my question is whether that is an overly broad statement, since the paper appears to narrowly relate to only announcements of accounting restatements.
Could you please state again the claim in the economic analysis and the specific paper you're referring to?
Yeah, so it's on page 93 of the adopting release, and the economic analysis states that more recent research from its calendar year suggests that audit partner disclosures in Form AP provide useful information to equity market. But the study that it referenced is very narrowly focused on the announcement of accounting restatements. So my question is, do you think that's an overly broad statement to reach based on this narrowly focused study?
So without knowing which specific study you're referring to, I'm unable to answer that question.
Okay, well, I can follow up with you on that.
I would appreciate that very much. Happy to speak offline about any and all of your questions you might have.
Thank you. Back to you, Chair Williams.
Thank you. Board Member Stein, the floor is yours.
Thank you, Chair Williams. The second item before the board today is a staff recommendation to adopt enhancements to the PCAOB's registered firm reporting framework. In June 2008, the board first established the foundation of a reporting and disclosure system for registered public accounting firms. The board's reporting framework included two types of reporting obligations. One, an annual report of basic information about the firm's practice over the last 12 months. And two, a special report triggered upon the occurrence of certain events affecting the firm, such as certain legal proceedings or the awareness of an issuer's failure to report certain matters to the United States Securities and Exchange Commission, or such as a change in auditor or a withdrawal of an audit report. Much has changed, though, since the board set up this reporting regime 16 years ago. The business landscape increasingly favors technology and data-driven enterprises. Earlier today, the board approved a final rule focusing on informative metrics to help make audit firms and their audit engagements more transparent to investors and the capital markets. The staff recommendation before us now recognizes that the PCAOB performs its oversight in an increasingly data-driven world. Accordingly, the PCAOB needs relevant and reliable operational data to inform our oversight of the audits of issuers and the examinations of broker-dealers. In my view, some of the crucial elements of this recommendation include: through an updated annual report, Form 2, firms will now share more relevant information about the firm's legal structure, its ownership, and governance. And for the first time, firms will also provide details about network arrangements, and the largest firms will submit financial statements confidentially. 2, through an updated special report, which we call Form 3, firms will report significant cybersecurity incidents and information about material events that have the potential to significantly affect the firm's operation of its audit practice. The enhancements to the audit firm reporting framework will contribute to effective monitoring and efficient deployment of the board's finite resources. I am pleased that the staff, in response to comments, applied a principles-based approach with flexibility for firms. For example, the staff declined to prescribe the form and content requirements for financial statements, instead allowing firms to report in a manner of their choice, as long as they report on an accrual basis and they disclose significant ownership interest, private equity investments, unfunded pension liabilities, and related party transactions, including those with other members of a global network. The staff also tailored the final rule for provision of financial statements to those firms issuing more than 100 audit reports each year. I am, however, disappointed that much of this information being reported to the PCAOB has been deemed non-public. While I recognize that most of this reporting is new for audit firms, investors and other stakeholders also have an interest in the changing dynamics of these firms, including novel firm arrangements that include infusions of private equity. I hope the board will conduct a review in the future of the firm reporting framework at the proper time and reconsider the need to provide transparency to investors, other stakeholders, and the public. I do want to commend the staff for their hard work on this project. In particular, I would like to thank Catherine Kelly, Mark Francis, Damon Andrews, and Connor Rasso from the PCAOB's Office of the General Counsel. Dylan Razier also helped with the project from the Office of Economic and Risk Analysis, and Jessica Watts from the Office of the Chief Auditor. Thank you, and I am very pleased to support the staff recommendation. I'll hand it back over to you, Chair Williams.
Thank you. Board Member Thompson, the floor is yours.
Thank you, Chair Williams. I support amending PCAOB reporting requirements to increase the amount of information available to investors and to the board about registered audit firms. In my view, good data helps to drive better decisions, both for investors in making investment and voting decisions, for the board in faithfully executing its oversight function. Auditors play a critical gatekeeping role in our capital markets. Currently, however, there is limited public information regarding the firm governance and network arrangements that some firms participate in. Additionally, as a regulator, our board should be apprised promptly of material firm events or incidents that could significantly impact a firm's audit practice. I believe that the firm reporting amendments before us today will enable investors and the board to analyze more decision-useful data in making assessments of firms and the audits that they conduct. One example of this data is the enhanced information that will be required in firm annual reports. Currently, the annual report on Form 2 requires a firm to disclose information about its practice, including identification of audit reports issued to issuers and or broker-dealers, disclosure of the firm's offices and affiliations, and details regarding a firm's personnel, including the number of CPAs. Under the final amendments, registered firms will be required to provide governance information, including data about its leadership, legal structure, and ownership. Additionally, to the extent that a firm is part of a network, it will need to describe its network arrangement, including whether it can access network resources, such as audit methodologies and training, and whether the firm has any financial ties to other firms within the network, such as a loan agreement. This level of transparency regarding a firm's operations will better enable investors and the board to assess opportunities and potential challenges that a firm may face. Additionally, the board will have a greater insight about the financial standing of the largest firms, given the new requirement for such firms to provide financial statements to the PCAOB on a confidential basis. Through our inspections programs, we identify high-quality audits and poor quality audits. Given our mission, we are always considering what regulatory tools can be activated to drive improved audit quality. On the one hand, we want to share good practices when we find them, and on the other hand, we want to understand the circumstances that yield poor results and provide support and guidance where appropriate. A firm's governance impact its culture, and culture often drives results. As our staff has previously indicated, we are doing a deep dive to better assess how firm culture may correlate with inspection results. The enhanced disclosures on Form 2 will enable the board and investors to make more informed assessments and comparisons of firms' operational framework and how such frameworks impact audit quality. Some commenters on our proposal were of the view that voluntary firm transparency reports and/or voluntary audit quality reports have sufficient information to the public. While some of the information required by the final amendments is already disclosed by firms, one of the challenges with voluntary firm reporting is that the information is not standardized across firms. Additionally, methodologies can differ from firm to firm and from year to year, and there are firms that do not issue transparency audit quality reports. Today's firm reporting amendments will help standardize reported information across registered firms and will increase the level of transparency in firm governance and operations. Another example of decision useful information that will be required relates to reports about material events that firms must submit to the board on a confidential basis. This requirement would encompass material events pertaining to a firm's organization, its liquidity, and financial standing, including, for example, whether a determination has been made that there is substantial doubt that a firm's ability to continue as a going concern. As a regulator with a mission to protect investors, I believe that it is important for the board to be informed about significant events in the life of a firm and to obtain such information as quickly as possible. The board wants to ensure that it learns about potentially market-moving events from registered firms first and not from the news headlines. It is important to note that we have scaled this component of the amendment such that it only applies to firms that are annually inspected by the board. The final data enhancement that I will note at this time is confidential disclosure concerning significant cybersecurity incidents, which will be reported only to the board, and public disclosure regarding a firm's cybersecurity policies and procedures. Those of us who leverage technology in our everyday lives for things such as personal banking and communication with medical providers understand the need for robust cybersecurity policies and procedures. When we receive email alerts or letters in the mail regarding how personal data that we've entrusted to a reputable service provider or repository have been compromised, we consider whether there will be adverse effects on our identity and our resources. We also question whether our personal information was sufficiently safeguarded. We know quite well that cyber incidents can cause major disruptions for individuals and for the companies and firms targeted. As such, the board should be informed on a prompt basis of significant cybersecurity incidents that could adversely affect a firm's ability to conduct its audit practice. Additionally, the public should be able to discern the robustness of a firm's policies and procedures relating to cybersecurity. As outlined in our release, our staff has discerned that cybersecurity incidents at audit firms are increasing in both volume and complexity. If a firm suffers debilitating effects from a cybersecurity incident, if accounting and financial data it holds are compromised, the impact on issuer and broker-dealer audits can be expansive. Again, as a regulator with a mission to protect investors, prompt knowledge of such cybersecurity incidents will enable the board to swiftly assess how to help preserve the integrity of the audit and ultimately our capital markets. With these considerations in mind, I support adoption of the final amendments. As discussed in the release, investors will be able to digest more information about registered firms, which may influence their investment and voting decisions. Further, the additional information and more timely data about registered firms' operations will better inform the board's oversight decisions, including deployment of inspection resources, improvement of our rules and standards, and consideration and analysis of confidential firm information to more effectively advance our investor protection mission. In closing, I want to thank commenters for their thoughtful insights with respect to this project. The adopting release reflects a number of ways in which we acknowledge and address commenter viewpoints, including one, our decision not to require that financial statements be reported in accordance with the applicable financial reporting framework in a firm's jurisdiction, and two, our decision not to accelerate the filing date for all Form 3 filings and instead only require that material events and cybersecurity incidents be subject to accelerated reporting. Overall, I believe that the final amendments before us today benefited tremendously from commenter input. The road to adoption of our rules and standards is typically an intensive and excessive undertaking that requires input and insight from across our organization. As such, I want to thank several members of our dedicated staff for their contributions to this project. From the Office of General Counsel, James Capoli, Connor Rasso, Catherine Kelly, Damon Andrews, and Mark Francis. From the Office of Economic and Risk Analysis, Martin Schmaltz, Eric Durbin, Dylan Rasser, and Carrie Von Bose. From the Office of Chief Auditor, Jessica Watts, Karen Wiedemann, Lynette Clendist, David Elam. From the Office of Enforcement Investigation, Kristen Van Vossen, John Abel, Kara Armstrong, Brent Cullings, and Tina Bale. From the Division of Registration and Inspection, Christine Gunier, Tim Sykes, Carol Swaniker, Michael Stevenson, Alan Kerwin, Pamela Robinson, Eugene Theron, and Kathleen Otashevsky, and Abina Glasgow. I also want to thank my fellow board members and my staff for their attention and contributions to this project. And finally, I would like to thank the staff at SEC's Office of Chief Accountant for their assistance with this project. Thank you.
Thank you. Board Member Bodick, the floor is yours.
Thank you again, Chair Williams. I am pleased to support the adoption of firm reporting, which consists of amendments to the PCAOB's annual and special reporting requirements to mandate the disclosure of more complete, standardized, and timely information by registered public accounting firms. Prior to the adoption of these amendments, the basic framework of the PCAOB's annual and special reporting requirements has not been substantially reconsidered since its adoption in 2008. The world has changed a great deal over the last 16 years. Concerns over audit firm health and viability remain a priority for us and a focus of all our oversight activities, but the circumstances that impact those factors have changed. Significant investments in advanced technologies, transformations in firm governance and structure, including but not limited to investments from private equity and other financing arrangements, and an audit pipeline challenge have ushered in a time of turbulence for the audit profession. Against this backdrop, the need for high-quality audits, independence, and a vibrant audit ecosystem has never been greater. This rule supports these objectives by providing the PCAOB with the information it needs to conduct its oversight activities efficiently and effectively. The recommendation before us today mandates the disclosure of additional information either annually on Form 2 or as a special report when certain events occur on Form 3. Our oversight activities and investor protection objectives depend on receiving information from firms in a consistent and timely manner so that we may respond promptly and effectively. These annual and special reporting rules benefit from staff experience over the past 16 years. Because of my experience in years of experience as a staff member in our Division of Registration and Inspections, I am particularly cognizant of the value that these new reporting requirements will bring to our inspection program. They will not only offer guidance on the firms that need monitoring or that need for inquiry into a given firm, but will also help to identify wider concerns within specific sectors that merit additional attention. I am confident that our staff will put this information to good use across all our oversight activities. I would like to highlight two features of this recommendation that I found of particular importance. First, enhanced audit fee information, governance and network information, and information related to a firm's cybersecurity policies and procedures will be reported publicly. Access to this information will help investors, audit committee members, and other users of financial statements better understand how firms are functioning and therefore provide a valuable resource for their decision making. Second, as noted in the release, these reporting requirements have been designed to augment other aspects of our rules and standards. For example, the information they collect will be useful not only on its own, but also in conjunction with other public information regarding audit firms, including existing Form AP information and pending SEC approval, firm and engagement metrics. In addition, the reporting requirements require that firms provide a description of the firm's external oversight function for the audit practice, which supplements certain requirements recently adopted in QC 1000. By focusing on firm structure and governance, as well as events that pose a material risk or represent a material change to a firm's organization, operations, liquidity, or resources, this recommendation will provide information that integrates into many of our most impactful programs. Different standards have different focuses, but they work together to advance the PCAOB's goals of investor protection and audit quality. As I mentioned at the proposal stage, the PCAOB was established in response to a series of events that caused investors to question financial reporting and the audit itself. Those of us who were there have a vivid recollection of those days. While thankfully we have not experienced events similar to those of the early 2000s, we must remain vigilant to identify events that might affect the healthy functioning of audit firms and by extension, the health of our capital markets. This is what this recommendation is designed to do. I want to thank all commenters who provided letters. Your thoughts and perspectives are always appreciated and helpful. I also want to thank and acknowledge the many staff members who worked tirelessly on this release and took the time to meet with me and my staff on multiple occasions on multiple drafts. Thank you to the staff of the Office of the General Counsel, the Office of Economic and Risk Analysis, the Office of Chief Auditor, the Division of Registration Inspections, and the Division of Enforcement Investigations. Thank you.
Thank you, Board Member Bodick. Before I call for a vote, I'd like to again acknowledge the tremendous work of our staff. As my fellow board members know, nearly 4 months ago, after considering comments, you informed the board that you'd be ready to move this project and firm and engagement metrics on November 14th, and I appreciate that you took the time you needed to get this right. I applaud your ability to work efficiently. Investors demand nothing less, and I thank you for your work. Unless there are any further discussions from the board, I would now call for a vote on the staff recommendation. Board Member Ho.
Oppose.
Thank you. Board Member Stein.
I support.
Thank you. Board Member Thompson.
I support.
Thank you. Board Member Bodick.
I also support.
Thank you. I also support the recommendation is approved with Board Member Ho dissenting. The final order of business before the board today is a staff recommendation that the board adopt the proposed budget for fiscal year 2025 and submit it along with the corresponding budget justification to the U.S. Securities and Exchange Commission. Under Section 109B of the Sarbanes-Oxley Act, the board is required to establish a budget for each fiscal year no later than 1 month prior to the beginning of the fiscal year. That budget is then submitted to the Commission for approval. To present the staff's recommendation, I will turn to our Chief Operating Officer, Jamie McNamara.
Thank you. Chair Williams and members of the board. I'm pleased to provide a brief overview of the PCAOB's 2025 budget, which is the result of collaborative efforts throughout the organization, as well as with SEC staff over the course of this past year. The budget is developed to achieve the goals and objectives of the board's strategic plan, as demonstrated by the related performance measures and indicators included in the corresponding budget justification. The budget for 2025 is $399.7 million. When comparing this to the PCAOB's 2024 budget, which was $384.7 million, is an increase of 3.9. Is personnel costs. This includes compensation, salaries, benefits, payroll, taxes, and recruitment. These costs total $300 million, accounting for 3/4 of the budget. When comparing personnel costs to the 2024 budget, which was $285.8 million, it's an increase of 5%. This resource level assumes that 945 positions will be filled by the end of 2025, one fewer position than in the 2024 budget. We continue to perform a thorough analysis of our staffing needs and believe these resources are essential to execute our strategic plan in support of our investor protection mission. Turning now to personnel costs. Consulting and professional fees at $34 million accounts for 9% of the budget. For rent and other facilities costs, including capital expenditures, the budget provides $19.8 million. This represents 5% of the PCAOB's 2025 budget. The information technology expense and capital expenditures category, which includes costs for things such as software licenses and network and telecommunications services, is $18.3 million, or 5% of the budget. The budget includes $16.5 million in travel-related costs, which account for 4% of the budget. Inspections-related travel accounts for about 90% of the PCAOB's travel costs. Finally, the administrative expenses category, which includes items such as subscription and library, business insurance, and event costs, is $11.2 million. Administrative expenses make up the remainder of the budget, or 3%. Regarding the accounting support fee, all of our budgeted costs are funded through the accounting support fee assessed on issuers and brokers and dealers. The accounting support fee associated with the 2025 budget is $374.9 million in total. When comparing the accounting support fee to 2024, which was $358.8 million, it's an increase of 4.5%. The share of the accounting support fee for issuers is $346.1 million, and the portion allocated to brokers and dealers is $28.8 million. The budget also assumes that at the end of 2025, the board will have 5 months of reserve operating resources for early 2026. This reserve is calculated in accordance with Rule 190 of Regulation P, which governs the Securities and Exchange Commission's review and approval of our budget and annual accounting support fee. To conclude, I would just like to add that the development of the budget involved many hands. I would like to quickly note my appreciation for the combined effort of all our colleagues throughout the PCAOB and the support provided by each of the board members and their staff. With that, I recommend that the board adopt the 2025 budget and corresponding budget justification substantially in the form before you, in accordance with Section 109B of the Sarbanes-Oxley Act, as amended. I'm happy to answer any questions the board members may have.
Thank you, Jamie. At this time, my fellow board members and I will have an opportunity to make a statement or ask questions to the staff. We will proceed in the order of seniority, and I will begin. I am pleased to support the 2025 budget that provides the PCAOB with the funding necessary to execute our investor protection mission while maintaining essentially the same number of staff as assumed in the 2024 budget. Our work continues to be guided by the goals and objectives set forth in the 2022 through 2026 strategic plan. Since the plan was approved by the board 2 years ago, we have made significant advancements in protecting investors through our oversight activities. The 2025 budget will enable the organization to build upon this success through the dedicated efforts of the PCAOB's talented staff. The majority of our staff serve in our Division of Registration and Inspections, or DRI. The 2025 budget will enable our DRI staff to continue to build on our 2024 progress. Specifically, the 2025 budget will enable our 430 staff in the firm inspections group to continue their outstanding work in conducting domestic and international inspections. By the end of 2024, our staff expect to have inspected 232 audit firms and 930 audits across domestic annual, domestic triannual, international, and broker-dealer audits. These numbers include 79 international inspections of firms and 226 audits, including audits of firms in mainland China and Hong Kong. DRI staff continue to work diligently to issue timely inspection reports, and the 2025 budget will allow us to continue to meet our strategic objective in that regard. This year, we successfully improved the timing of issuing our inspection reports of both annually inspected and triannually inspected firms, providing the reports to the public months earlier than in recent years. We also published new charts on our website that illustrate data from the annually inspected firm reports that increase the transparency of our inspection data and make it easier for investors and others to understand and compare inspection results, both across firms and over time. Further this year, we increased our outreach activities that deliver useful guidance to the audit profession, including audit committees, auditors, and other stakeholders, through our staff spotlight reports, which highlight emerging risks, trends, and other observations from our inspection activities to further our stakeholders' understanding and support their efforts to proactively improve audit quality. Of course, the 2025 budget also enables our staff to continue to focus on remediation and providing guidance to firms as they prepare to comply with new standards, including QC 1000. The 2025 budget includes the resources necessary to continue to drive our inspection activities in support of our investor protection mission. Our staff in our Office of Chief Auditor, Office of Economic and Risk Analysis, and the Office of the General Counsel have worked diligently to update our standards and rules. With today's adoptions of the firm and engagement metrics and firm reporting projects, the board has taken more formal actions on standard setting and rulemaking this year than any year since 2003 when the PCAOB was established. This budget provides the funding to direct our focus to other standards that have not been updated since they were adopted by the board in 2003 and are in need of modernization. This budget will also provide resources for us to develop materials to assist firms with updating their methodologies and training their staff on the upcoming changes. The staff of our Division of Enforcement and Investigations continue to focus on cases with significant audit violations, failures to comply with auditor independence rules, and matters threatening the board's oversight activities, such as non-cooperation with PCAOB inspections and investigations. So far in 2024, we have issued over $35 million in fines, all of which is directed toward funding scholarships for accounting students. But we also go beyond issuing penalties and use other important forms of relief. For example, where appropriate, we revoked firm registrations and barred bad actors from conducting PCAOB audits. We required functional changes to a firm's supervisory structure, and we required firms to retain an independent monitor to drive improvements and best protect investors. This budget provides us with the resources to continue to hold bad actors accountable. We must continue to be good stewards of the fees collected to fund the PCAOB. This means making sure our organization operates as effectively as possible and strives to challenge the status quo as we execute our mission. To improve organizational effectiveness, this year, we elevated our approach to stakeholder engagement. For example, we enhanced our outreach and support for smaller audit firms by organizing a nationwide series of in-person and virtual forums for auditors of small businesses and broker-dealers, with each event hosted by a different board member. The forums provide the PCAOB an opportunity to share valuable resources and information with small firms to help them improve audit quality, while also giving us a chance to hear from them directly about their unique needs and challenges. In addition, our Office of the Investor Advocate issued 7 investor advisories and bulletins so far this year. These publications provide timely guidance and accessible background material to broaden and deepen investors' understanding of PCAOB standard setting and rulemaking activities, and more generally, the audit profession. We also continue to focus on improving our well-functioning internal processes and information technology capabilities while investing in our highly skilled staff. Without this focus, none of the accomplishments I just described, along with countless others, could have been achieved. Our people are imperative to successfully executing our mission. This is why it is appropriate that approximately 3/4 of this budget relates to compensation, which is also consistent with past budgets. This budget enables us to both provide our staff with competitive compensation that acknowledges their tremendous efforts on behalf of investors and retain them, as well as attract new expert talent to help us meet our investor protection mission. In closing, I would like to thank everyone who played a role in finalizing the 2025 budget. I would like to specifically thank my fellow board members and PCAOB staff for their collaboration. I would also like to recognize our Chief Operating Officer, Jamie McNamara, our Chief Financial Officer, Holly Greaves, our Budget Officer, Jim Hearn, and the rest of their team, Yas Masajian, Alfredo Azakar, Marcia Saavedra, and Lorene Rosenberg, along with leadership of each of the divisions and offices for their efforts on the budget. Lastly, I would like to thank Chair Gensler and the commissioners and staff at the Securities and Exchange Commission for their support and guidance. I will now turn to my fellow board members for any statements they would like to make or questions they would like to pose to the staff. Board Member Ho, the floor is yours.
Thank you, Chair Williams. Today, I will be casting my 4th annual budget vote since I joined the PCAOB board in November 2021. Under this board, the PCAOB budget has ballooned by 40% from the 2020 budget of $284.7 million. Although I supported the past 3 years' budget, I repeatedly urged the PCAOB to exercise fiscal discipline and proactively identify efficiency gains. This year's proposed budget of $399.7 million is a 4% increase from the 2024 budget of $384.7 million. Although the staff has recommended a budget that does not include a double-digit increase like the prior 2 years, I believe the requested increase is neither necessary nor justified for the following 2 reasons. First, since 2018, PCAOB has consistently underspent its budget by over 7% on average. Every prudent budget formulation officer knows that an agency that consistently underspends its budget authority is unlikely to be successful in defending future requests for more budget authority. If we have not been able to spend on average 7% of our budget authority annually, I question whether there is an actual need for a 4% increase in the 2025 budget. When I look at the broader budget environment at federal agencies, including our oversight body, the SEC, I doubt few have seen annual increases in budget authority comparable to that of the PCAOB. Second, PCAOB's mission is to protect investors. I believe that we can fulfill our mission of investor protection by helping audit firms and their personnel succeed, which will also benefit investors and enhance the resilience and robustness of our capital market ecosystem. Although the number of activities and output under this board has increased dramatically, audit quality outcomes remain elusive, especially based on PCAOB's own measurement of deficiency rates. The PCAOB continues to use its highly publicized 46% deficiency rate in the 2023 inspection reports as an indicator that audit quality is deteriorating. Indeed, the deficiency rates have consistently increased under this board to the historical high of 46%, from 29% in 2020, 34% in 2021, and 40% in 2022. One may wonder if the PCAOB's 40% budget increases since 2020 has not helped improve audit quality. Is it time to think differently about its resource allocation? As a board member, I believe that we should be held accountable for good stewardship and outcome-based performance. It would be irresponsible to continue the same path of not achieving outcomes that investors deserve. For these reasons, I do not support this proposed 2025 budget. I would like to express my thanks to PCAOB COO Jamie McNamara, CFO Holly Greaves, and Budget Officer Jim Hearn, who continue to work diligently each year on the budget. I also thank the PCAOB division and office directors and the rest of the PCAOB staff who have worked tirelessly to formulate this budget. I now have a few questions for our Chief Financial Officer. Hi, Ms. Greaves. Why are we asking for more when the budgets have historically been underspent?
Well, thank you, Christina. That's a very important question. Before I answer, I did just want to note for the public attending that under Sarbanes-Oxley, any underspends in our budget, they're actually applied to the following year's accounting support fee calculation. So ultimately, any underspends in our budget do reduce the accounting support fee that is used to calculate the amount individual issuers and broker-dealers pay to support our operations. I do want to address your question directly. For our differences, the majority of our differences have been related to compensation and travel, and I'll speak to each of those separately. As it relates to compensation, the shortfall that we've seen in recent years has really been related to the challenges many organizations faced around hiring talented staff. It has been a board priority to increase the number of staff that we have, particularly in our Division of Registration and Inspections, and we have done just that. Regarding travel, during the pandemic, the board moved to remote inspections, like many of the organizations who transitioned to different operations during the pandemic. And coming out of the pandemic, the board transitioned to voluntary travel. And the number of staff volunteering to perform the inspections in person was initially less than we budgeted, and that led to a shortfall. We have seen very positive trends in the number of staff volunteering to travel, and we've refined our assumptions to reflect that trend, as well as trends in our hiring. So I do not expect such shortfalls to continue in 2025, and in fact, we're projecting much better results for 2024 as well.
Thank you, Ms. Greaves. I actually think that it's helpful that you provided that clarification about the surplus get calculated so that we don't keep it in a piggy bank. That's what I believe you mean. And then also that actually in essence is no different from federal agencies, because if they don't spend their budget authority, Treasury, they get sent back to Treasury. So, but thank you for the clarification. And I also do want to highlight the fact that it's actually this underspent is not just during the pandemic year. It has been that way, at least based on my review, since 2018. My next question is, what efficiencies do you hope to see or anticipate in 2025 to support fiscal stewardship?
Thank you. That's another great question. The budget justification document does highlight many of our efficiencies. I'll share just a couple that I'm particularly pleased with. A significant portion of our budget every year is devoted to lease expense. And in the last year, we've made significant progress reducing our lease costs for 5 of our offices.
The 2025 budget also reflects adjustments to our benefit packages. As you know, compensation, as many of us have remarked, is approximately 3/4 of our budget. So those adjustments are not inconsequential. Some of our efficiencies do relate to cost avoidance rather than cost savings. Our investments in IT are a good example of this. Sometimes these investments have a one-time upfront costs, but I do believe that they will achieve long-term efficiencies. And in cost alone, we did make efforts to decrease those one-time costs for our most significant IT investments in 2025.
Okay, well, thank you for the additional information. I appreciate your responsiveness. Back to you, Chair Williams.
Thank you. Board Member Stein, the floor is yours.
Thank you, Chair Williams. As I've said in the past, the budget goes beyond mere numbers. Today, my fellow board members and I are looking ahead and setting out a vision for the Public Company Accounting Oversight Board for the next year. Our nation's economy is powered by our $120 trillion capital markets, where investors and issuers come together in a capital raising environment that outpaces the banking sector by fivefold. And since 1933, public company auditors have served a vital role in the integrity and efficiency of our capital markets. As we all know, investors and the public in general place an immense amount of trust in independent auditors. And Congress placed a co-equal amount of trust in the PCAOB to oversee the audits of these independent auditors. Representative Michael Oxley, who is a co-author of the Sarbanes-Oxley Act, once succinctly explained why this matters. We often think of money as a currency of a free market system, but in truth, the system rises and falls on the confidence of its investors. So, it bears repeating, the auditor's report matters. In fact, it matters a great deal to the investor, the issuer, and the U.S. economy. In 2022, this board unanimously adopted a 4-year strategic plan to enhance the relevance and the reliability of the audit and to focus on 4 critical areas: updating and modernizing the responsibilities of the auditor, evaluating and reporting on whether auditors are fulfilling their responsibilities, preventing and deterring future violations by strengthening our enforcement and disciplinary program, and 4, driving organizational effectiveness and empowering our employees. So let me talk a little bit about updating and modernizing the responsibilities of the auditor. When I first started my job as a board member, I was surprised to learn that the PCAOB was inspecting against standards written by the profession 30 or 40 years ago. In 2003, the PCAOB adopted on an interim basis the auditor's responsibilities as set out in standards written by the American Institute of Certified Public Accountants. Many of the standards had been written for an era dominated by fax machines, not fast-paced global digital commerce. In fact, many PCAOB auditing standards are still considered interim standards. So in 2022, the board challenged the staff to bring to completion updates to those standards, most of which predated the creation of the PCAOB, which was designed to be an independent standard setter. For example, in 2024, this year, the board finally got over the finish line, a standard to overhaul a firm's system of quality control, QC 1000. The PCAOB staff, however, had been studying and working on the matter for quite some time. 10 years before the board's adoption of QC 1000, the PCAOB Standing Advisory Group, the SAG, recommended that the board strengthen the quality control standards and develop a risk-based approach. Over the next several years, PCAOB staff conducted observations of firms' QC systems, reviewed relevant academic research and literature, noted developments and trends in internal control, enterprise risk management, and quality management frameworks, all of which reflect a shift towards more proactive and risk-based approaches. And we observed the work of other standard setters, including the International Auditing and Assurance Standards Board's proposal on quality management for firms that perform audits or reviews of financial statements or other assurance-related service engagements, called ISQM1 for short. Work progressed with the issuance of a concept release on considerations related to any potential revision of PCAOB's quality control standards in 2019. Finally, in 2024, the staff recommended adopting a final standard that had been in the making for more than a decade and informed by several rounds of public comment. This is an example of the work the PCAOB staff accomplished in the past year. During the past 3 years, I am proud to say the board has now updated approximately half of the interim standards and will use the allocated funding in this budget to continue this important work. And our second mission that we set for ourselves was to evaluate and report on whether auditors are fulfilling their responsibilities. In 2022, the board also challenged the staff to enhance both the timeliness and the informativeness of inspection reports. This past year, the PCAOB staff inspected approximately 250 registered firms and looked at over 900 audits. We have worked to provide more information in our inspection reports to increase their usefulness for investors, other stakeholders, and the public, including more commentary on identified deficiencies, additional charts and graphs related to firm and partner tenure, and more information on auditor independence. The PCAOB has also taken steps to improve the informativeness and accessibility of inspection reports. In August 2024, the PCAOB website was updated to include data visualizations that summarize and compare the U.S. global network firms and the U.S. annual non-affiliate firms inspection reports. With appropriate support and funding, our staff not only has gotten rid of a backlog of reports, but is getting the reports published within 6 months of the inspection being completed. The board approved all 2023 annually inspected firm inspection reports by the end of June of this year, or in 6 months. To put it in perspective, in the year before, it took 12 months, or until December 2023, for all of the 2022 inspection reports to be issued. Our third objective, preventing and deterring future violations by strengthening our enforcement and disciplinary program. In 2022, the board also challenged the enforcement staff of the PCAOB to revitalize the program to prevent and deter violations of auditing standards. In response, the staff recommended enforcement actions in response to conduct uncovered through investigations and sweeps that reinforce the importance of audit firm compliance with the board's standards and rules. Although this is a tool in the toolbox that we prefer to use as a last resort, it does send a message to the entire audit marketplace that egregious violations of the auditing standards will not be tolerated. Finally, our fourth objective in our strategic plan, driving organizational effectiveness and empowering our employees. In 2022, the PCAOB reconstituted and revitalized its advisory groups. Both the Investor Advisory Group and the Standards and Emerging Issues Advisory Group have been weighing in on how to improve the audit and the audit marketplace. PCAOB continues to improve organizational effectiveness by meeting with different stakeholders. This included in the past year holding 5 forums on auditing in the small business environment and auditing small businesses who are auditing in the small business environment and auditing broker dealers. I had the pleasure of hosting one of these forums in September in Denver, Colorado. As all this work, all of it, is outlined in our strategic plan, it requires resources for staff, technology, and support. I am glad to see that the budget before us today provides that support. So in conclusion, I am proud of the work that the staff and the board have completed to modernize auditing standards, to adopt rules to prevent and deter misconduct, to enhance both the timeliness and the transparency of our inspections of audit firms, and to improve organizational effectiveness. I am pleased to support this budget because it sets out an allocation of resources that we need to continue in the direction we are going in to achieve our mission. I want to thank the PCAOB staff, including Jim Hearn, our budget officer, Yos Misagian, Holly Greaves, and Jamie McNamara. I also want to acknowledge the SEC staff's frequent communications on the budget and other areas of professional practice. The budget process begins early each year and involves a team from the SEC and a team from the PCAOB. This is just one example of the Commission's general oversight authority. Thank you, and I will turn the mic back over to you, Chair Williams.
Thank you. Board Member Thompson, the floor is yours.
Thank you, Chair Williams. My reflections today are based on my 5 decades of work experience, which include an intimate familiarity with what it takes to produce a budget that reflects appropriate resourcing to achieve mission objectives. As a 5-person board, we each bring different strengths to the table. From my senior executive roles at the CFTC and USDA, along with my role as the Director of Air Force Budget Programs, overseeing sensible and responsible budget has dominated a significant portion of my career. I have been in the rooms where tough budget decisions entail balancing between what is aspirational and what is achievable. In my discussions with PCAOB staff, I continue to emphasize identifying areas of efficiencies through leveraging technology and reasonable staffing considerations. And I believe the staff have successfully put forth a today sensible budget that reflects these efforts. I put my full support behind the 2025 budget, which reflects our staff's thoughtful approach to allocating resources in support of our public interest and investor protection mission. The PCAOB lives on its mission every day. Our mission is the foundation of our strategic plan, which then drives our budgeting and allocation resources. I'd like to reflect on how we've woven this together. When our current strategic plan was voted on by the board on November 18, 2022, it was a unanimous vote. The 5 board members at that time voted in support of the ambitious agenda that we embarked upon, which includes our 4 priorities of modernizing standards, strengthening enforcement, enhancing inspections, and improving organizational effectiveness. We moved forward, eyes wide open as to the level of effort and resourcing necessary to accomplish such a bold agenda in support of our public interest mission. It also reflects and incorporates the comments from our stakeholders. I have said before that our strategic plan would not sit on a shelf and collect dust. Our staff daily operationalizes the goal and objectives set forth in that plan. Further, the strategic plan continues to shape our annual budget, including this budget for 2025. Today's budget before us reflects a modest 3.9% increase from the 2024 budget and would fund 945 positions, 1 position less than the budget in 2024. And I may add, with pricing on any steady state budget, it will increase if you do nothing more than maintain your staff for the following year. Price will increase at a rate of inflation. It reflects our efforts to wisely use our resources by capitalizing on technology improvements and expanding on our in-person oversight activities while maintaining an essentially flat headcount to effectively and efficiently achieve our mission critical goals. Consistent with our history, our biggest asset is our people, which is also appropriately means that it is also our biggest cost driver in the budget. Personnel costs represent approximately 75% of our budgeted costs, consistent with our prior budgets. Given the significance of our personnel costs, I would like to highlight the ways I have directly observed the work of our highly dedicated and technically gifted staff in 3 of our 4 mission critical divisions. OCA, DRI, and DEI. The budget directly reflects our faith in the PCAOB staff, our staff who are tirelessly dedicated to our mission of investor protection. The trust in our U.S. capital markets is partially built on the shoulders of our staff's committed efforts. The names of our staff are mostly unknown to the average investor, but they are doing unseen work to protect the deepest and most liquid capital markets in the world. Let's start with the Office of Chief Auditor. In OCA, our staff of 31 people are responsible for monitoring current or emerging issues, developing a research agenda, and working on all standard-setting projects. This team also supports the implementation of our standards and rules through a combination of stakeholder outreach, publishing staff guidance, and other activities to improve the quality of audit services. With our goal of modernizing standards, this technically gifted group of primarily CPAs and lawyers work in teams to provide before the board all matters involving our standards and rulemaking. With the 5 standards and the 2 rulemaking projects already adopted by this board these past 2+ years, and the 2 projects before the board today, this board is executing on the first goal of our strategic plan to modernize interim standards and rules that have not been revised in decades. There is collectively within this small but mighty office hundreds of years of technical experience. I have witnessed them present at dozens of conferences and advisory group meetings over several years. Their work supports the development of PCAOB standards and rules, which set the bar for high-quality audits. Let's discuss the impact of our Division of Registration and Inspections. Over the past 3 years, I've directly observed our staff in action doing our inspections and oversight activities. In particular, I made it part of my personal agenda to observe a sample of inspections in various aspects of our inspections oversight process. I have observed a GNF inspection, an NAF inspection, a non-US inspection, and a BD inspection. By directly observing our inspection staff in the field, I have experienced the technical expertise of our boots on the ground. Our inspectors are laser focused on inspecting to our standards. By observing various inspections, it is clear to me that we appropriately tailor the composition of our teams to the size of the firm and complexity of the issuer or broker-dealer audits. When staffing inspections, DRI takes into consideration accounting, auditing, and industry expertise, as well as language skills as appropriate. The staffing of our oversight activities is meticulously maintained to promote consistency and completion of our inspections and registration programs. Annually, on average, our 517 DRI staff accomplished the task of managing registration of 1,545 registered firms, inspecting over 200 audit firms, and parts of more than 700 issuer and broker-dealer audits across more than 30 jurisdictions. They're inspecting the audits of almost $120 trillion of the U.S. capital markets, which is a fundamental for us to maintain the public trust. Our Division of Enforcement Investigation plays a crucial role in ensuring that audit firms and brokers and dealers adhere to the highest standards of quality and integrity. We have strengthened our enforcement program consistent with our strategic plan. It is evident that some audits do not reflect the audit quality that investors deserve. The division of 76 professionals focuses on identifying misconduct that damages investor trust. As you've seen in the press, we sanction for a range of conduct from audit committee communication failures to exam cheating and non-cooperation with our investigators. Providing appropriate resources to this division through our budget ensures that misconduct is sufficiently and consistently investigated and sanctioned to deter future misconduct. Our enforcement actions are aimed at reinforcing the importance of compliance with auditing standards, promoting transparency, and protecting investors by ensuring that all audits meet the rigorous standards required for accurate and reliable financial reporting. Now, I realize the PCAOB is more than just 3 divisions and offices, but I use these as examples of the mission-critical work that motivates the budget before us today. Woven into this budget is the promise of technology to build efficiencies into our processes, minimizing the need for additional headcount. To be effective at our mission, we must appropriately resource oversight activities through personnel costs, technology enhancements, and streamlined procedures. To be resource deficient in any mission critical area could jeopardize the trust that the capital markets place in our work. I would also like to take this time to applaud the contributions of the PCAOB staff and our Office of Chief Operating Officer, including Jamie McNamara, our COO, Holly Greaves, our CFO, and Jim Hearn, our Budget Officer, and the outstanding budget team, including Yas Masajan, Alfredo, Azakar, Marcia Saavedra, and I also like to thank Lorraine Rosenberg, our Chief Strategy Officer. When I arrived as a new board member, the need existed for expertise specifically focused on long-term planning. Lorraine and her team have strengthened our long-term planning process and work closely with our budget and finance team. Additionally, thank you to those across the PCAOB's divisions and offices who have played an integral role in developing our 2025 budget. Lastly, I would like to thank the SEC staff, the chair's office, and my staff for their assistance and my collaboration with my fellow board members. Thank you.
Thank you. Board Member Bodick, the floor is yours.
Thank you again, Chair Williams. I served as staff at the PCAOB for 20 years before I became a board member. This experience has provided me with a comprehensive vantage point from which to evaluate the board's undertakings and an appreciation for the complexity of building the organization's budget each year from the ground up. Put simply, the PCAOB's budget is crucial to protecting investors, maintaining market integrity, and ensuring the reliability of financial reporting. There are two principles that guided me as I evaluated the budget before us today, which are the same as those I employed in reviewing last year's budget. First, does the budget include the appropriate level of resources to allow us to execute on the PCAOB's mission and strategic plan? And second, and of equal importance, is the PCAOB using the resources we have been allocated wisely in pursuit of our mission? I am confident this budget before us satisfies both of those principles. The headcount included in the budget reflects the needs of each of our divisions and offices and is consistent with 2024 levels. And the budget promotes the careful stewardship of funds with which we have been entrusted. I would like to highlight and emphasize 4 areas the 2025 budget will support throughout next year. First, although the PCAOB staffing complement of 945 individuals is consistent with the current budgeted headcount, I believe it will allow the organization to effectively perform all our oversight activities throughout 2025. In particular, the staffing level of our largest division, the Division of Registration and Inspections, will ensure our inspectors are able to meet the requirements mandated by the Sarbanes-Oxley Act and that we are addressing all appropriate risks in an efficient and effective manner. Second, in 2022, the PCAOB secured complete access to inspect and investigate registered public accounting firms headquartered in mainland China and Hong Kong. This historic and unprecedented access was only possible because of Congress's passing the Holding Foreign Companies Accountable Act. As a result of this, our inspectors and enforcement staff, supported by the staff of the Office of International Affairs, has been conducting inspections and investigations of accounting firms headquartered in mainland China and Hong Kong since 2022. Our access to mainland China is exceptional among U.S. financial regulators and among audit regulators worldwide. It is a significant step towards improving the transparency and accountability of Chinese companies listed on U.S. exchanges and supports the integrity of our markets. The budget before us today includes funding to continue these critical activities to protect investors. Third, as noted in our research project on data and technology, auditors are expanding their use of technology-assisted analysis and are making significant investments to implement machine learning and generative artificial intelligence, or Gen AI, in the performance of their audits. The increasing reliance on technology in financial reporting and auditing necessitates a corresponding investment by the PCAOB in our own technological capabilities to effectively oversee registered public accounting firms. In particular, this budget includes technology investments for the Division of Registration and Inspections, the Division of Enforcement and Investigations, and the Office of Economic and Risk Analysis that are necessary to leverage the efficient work of our staff. Finally, in 2025, we will continue our efforts to provide outreach and guidance specific to smaller audit firms. I strongly believe that healthy audit firms of all sizes are necessary to meet the needs of investors and the capital markets. In 2024, we held 4 forums on auditing in the small business environment and on auditing brokers and dealers. I was pleased to participate in one of these. I believe that outreach to and hearing from smaller firms is critical to our mission. Over 1,000 individuals registered either in person or through live stream for these events, which allowed them to hear directly from and interact with PCAOB board members and staff. This is important work, and I am pleased the 2025 budget provides resources for 5 in-person forums. In addition to increasing publication of staff spotlight documents, our staff has recently launched Audit Focus, a series of PCAOB staff publications to provide easy-to-digest information to auditors, especially those who audit smaller public companies, with an eye towards protecting investors and improving audit quality. I am encouraged by our staff's creativity and initiative to target outreach to smaller firms. In closing, I want to emphasize that this budget maintains the board's current staffing level while making investments in technology and other initiatives that will allow us to work smarter as we perform the critical work of protecting investors and furthering the public interest in the preparation of informative, accurate, and independent audit reports. I would like to recognize the efforts and dedication of the staff in the Office of Chief Operating Officer, particularly the budget and finance team. Thank you.
Thank you. Unless there are any further discussions from the board, I would now call for a vote on the staff recommendation. Board Member Ho.
Oppose.
Thank you. Board Member Stein.
I support the budget recommendation.
Thank you. Board Member Thompson.
I support the budget recommendation.
Thank you. Board Member Bowden.
I also support the budget recommendation.
And I support the budget recommendation. The recommendation is approved with Board Member Ho dissenting. That concludes the PCAOB's open meeting for today. As there is no further business, this meeting is now adjourned. Thank you for your participation. You may now disconnect from the webcast and teleconference.